confirming the end of UK market support. But just hours later, the FT reports the central bank has signalled to lenders it could extend the emergency bond buying programme. Cable and futures pair earlier losses. Plus, recession risk. President Biden admits a downturn is possible. The president also says Saudi Arabia will face consequences for the OPEC Plus output cut.
How's this for a volatile session, Tom? I have to say there was a bit of whiplash after we had those Governor Bailey comments saying, yep, we have to get ready. The quantitative easing will stop in 3 days, and then actually privately saying to bankers, according to the FT, that they may not. First of all, I'm sure he's having a bad day. Market's probably even having a worse day. I know we're getting quite a lot of BOE speakers to try and unpack and get some clarity on what exactly is going on.
It's the Bailey bamboozle. That's the way I'm looking at it. And the way that markets are going to readjust, you're seeing some upside because you did have that FT report coming out and suggesting that, in fact, that support could be extended. But the whiplash is there in terms of the commentary from the head of the Bank of England over in Washington, suggesting again, as Francine was saying, they might step back on Friday and pressuring the funds there. And then the FT report suggesting, in fact, they could prolong it. The Bailey bamboozle is something that's rippling across these markets. You're looking like, though, after 5 straight days of losses across the equity space here in Europe and the US, that you're getting a bit of a turnaround. Part of that will be linked to that FT reporting. The FTSE 100 currently up just 0.1%. The Spanish IBEX currently down 0.2%, and you're gaining just 4 or 5 points on the CAC 40. Let's switch it over and see how things are adjusting then across these assets. Worth pointing out that when it comes to what's happening in the US, the latest official out of the Fed, Loretta Mester, saying there will be a need for further tightening to get a grip on inflation in the US. As we look ahead to that important print Thursday out of the States. Future stateside then pointing to gains of 0.6%, again after 5 straight days of losses. The pound, of course, in focus for us today on the back of everything that's been coming out of the BOE governor's mouth. GBP currently trading at 109. That is a gain of 0.2%. The US 10-year currently at 3.92, yields off just by 2 basis points. And Brent, $94 a barrel, gaining 0.3% after being lower on the day. An important story worth focusing on, and we'll unpack this for you later in the hour, is the story around a leak on a pipeline bringing oil from Russia through Germany, and the leak has been detected in Poland. We'll keep across that for you. Let's have a look now at some of those UK-specific assets. I just want to briefly focus on the pound again and the moves that we saw intraday. This is when that FT report came out suggesting that, in fact, the Bank of England could extend that support. The pound rallied on the back of that, gained at least. Currently up 0.2%. Let's quickly have a look at gilts then, because, of course, the commentary from Andrew Bailey did come out when gilt trading had closed. Currently 4.34, as you can see, on the 2-year, the 10-year at 4.52. That's a move of 8 basis points on the yield there. We'll keep across this story for you, of course, as markets continue to digest the whiplash from the Bank of England governor. Francine.
Yeah, if you're a bond trader today, you don't really know whether you're coming and going, because he was quite clear. You have 3 days to get your act in order, and then privately he says something else to bankers. So you want to really find out what Governor Bailey wants to do when officials speak. And then, of course, this is repricing around the world. Is this a Bailey pivot? Is it a Bank of England pivot? We also now think that we could be in a recession because the economy contracted for the month of August. When you look at, of course, some of the, sectors that are on the move, I have healthcare, energy, on the way up, but it's not huge, Tom. I know there's quite a lot of green, but again, the green are individual stocks gaining some 0.2%. So it's not that big a deal in terms of the biggest gainers. I have real estate down 1.2%, retail, bank, and financial services down 0.6%. So out of the 19 industry groups that make up the Stock 600, about 17 are down.
And this is really about the credibility of the Bank of England, and that credibility very much on the line. Of course, confusion then for UK investors. The BOE governor, Andrew Bailey, saying in Washington, vowing to end that emergency gilt purchase as scheduled on Friday, despite mounting pressure, market pressure to extend that program. That announcement sent the pound tumbling and gilt yields rising, with Bailey adamant that pension funds have just 3 days to sort out their liquidity positions. But this morning, the pound rebounding, as we mentioned, on a conflicting report in the FT, saying the central bank has actually indicated privately to bankers that it could extend the intervention beyond the deadline. Here's what the governor said in DC on Tuesday.
We've announced that we will be out by the end of this week. We think the rebalancing must be done. And my message to the funds involved and all the firms involved in managing those funds, you've got 3 days left now. You've got to get this done. Because again, part of the essence, I think, of a financial stability intervention is that it is clearly temporary.
Well, we're joined by Dan Hansen from Bloomberg Economics and Christina Aquino from our MLive team. Dan, when you look at good morning, first of all, I don't even say good morning because we're so kind of like hung up on what's going on with gilts and sterling overall. So what was a mistake? Telling private banks that actually he'll do more, or telling the whole world that they have 3 days to get their act together?
Well, I think with this, with what he said there in Washington, he's really put his credibility on the line. I mean, I think probably the mistake is the fact that this report has come out since. I think it's not looking good for Bailey at the moment, and it's what you're going to see over the next 3 days is a lot of volatility in the bond market, and his commitment is going to get tested. And it's still not out of the question that he has to reverse course. And we know with Bailey we've seen reverses of course in the past, but I think the mistake for me, at least, was the fact that this story was leaked. I think he gave a pretty strong message at the IMF in Washington, and I feel now that people are confused. And you've seen that with the whipsaw in sterling. You've been talking about this whipsaw this morning. That's exactly what's happened.
Exactly, that volatility. We've seen volatility of the pound at almost kind of record highs, at least highs we haven't seen for a number of years. Gilts currently, I'm looking at the trading on the 10-year. Currently, the yield's up 4 basis points, so coming off a little bit. Yield's actually lower at the front end on the 2-year. Christine, before I come to you, I just want to mark this John Authers quote, another fantastic opinion piece from Bloomberg's John Authers, and he says, "This is on course to go down as an all-time central banking gaffe." Christina Aquino, on the market reaction then to the whipsawing from the Bank of England governor.
Well, Tom, it's one thing, right, for the markets to deal with a trust turnaround that we've seen in fiscal policy, but it's another for them to deal with the Bailey bamboozle, as you mentioned. The central bank, up until this point, had been a beacon of stability and calm for markets when markets were melting down in reaction to the government's fiscal steps, or missteps, I should say. But this particular development really is not doing well for them in terms of the volatility that it has generated in markets that are already very, very nervous about the end of this BOE bond market intervention. And, you know, markets deal in absolutes, right? They either want to price in one definitive thing or another definitive thing. And so now that they're kind of caught in between, will they or won't they from the BOE, you'd expect them to kind of try and push the BOE in one way or another. And of course, the more market-friendly outcome is pushing the BOE to extend the bond market support to continue or bring back stability to bond markets that have really seen quite a volatile ride over the last few weeks.
Christine, what exactly is the mistake? And first of all, I do need to correct myself because I seem to imply that it was Governor Bailey himself, according to the FT, that told bankers that he would continue with the support. We understand it's BOE officials, so that has to be corrected because we don't want to say anything that we don't think is true or that we don't know of. But Christine, I mean, we talked about yesterday the fact that the BOE probably needed to persist with some of the backstop for another 2 weeks, maybe into the BOE meeting, to make sure that the stability of the bonds was ensured. So what was a mess? The fact that he went to Washington and said in 3 days we're pulling out, or that now there's all this uncertainty?
I think it would be the latter, Fran. I think not kind of indicating at least any sense of flexibility over the timeline for it. I can completely understand from the bank's point of view that this is not something that they want to keep going, especially because it does put them in an awkward position, right? They want to be focusing on fighting that inflation fight and really persisting with that tightening policy. But now they have this financial stability issue that is probably more acute and more imminent, but but longer term, that makes the trajectory of their policy a little bit uncomfortable to navigate. But I think it really is that kind of absolute message that is going to be ending in 3 days that kind of really did not leave the bank a lot of wiggle room in terms of delivering the message should they need to extend the support, as Fran was mentioning, probably beyond the Friday deadline and into that November Bank of England meeting.
Yeah, and that absolutist position being watered down by this FT reporting. Dan, what is your sense? Do you think they're going to have to continue and are going to have to push through Friday with this support? What is your assessment at this stage?
Yeah, so, I mean, our view is he's going to have to backtrack. So I think yesterday I spoke to Fran on the show and I said, we think they're going to have to at least give a commitment to stay in the market, be around if there is a flare-up again, or in extremis, just carry on with the bond buying. So as I said at the start there, I think the mistake in terms of the communication from Bailey is that he said, this is going to stop on Friday, and then this story gets leaked about BOE officials. The policy mistake, I think, that's been made is around not, as Christine alluded to, giving the flexibility and being so forthright about what's going to happen on Friday, because we just don't know. And there could be flare-ups. There might be something he isn't telling us as well. He might know something that we don't know about the LDIs, and he feels more comfortable going out on a limb saying this. I'm less sure. So I think, for us at least, the idea of an extension or some sort of measure to prolong stability in the market is still on the table. And with all eyes on this fiscal event on the 31st, because ultimately that's the thing that needs to be rectified. That's the source of this problem, and that's what needs to be dealt with.
Dan, I think very quickly, why do you think he was so adamant that it would stop in 3 days?
Well, as I say, I think it's possible. He's spoken to the funds, and the bank knows a lot more about this than we know about. Yeah. There's also part of it that he's clearly very uncomfortable about, obviously, the moral hazard element of this, excess risk-taking that this sort of leads to. But it's also what I found most interesting was that he's really thinking about the interaction between this intervention and the monetary policy goal of the bank, and the fact that this is essentially QE. They're issuing reserves, the money supply is increasing, and they know with the other hand, they're going to have to raise interest rates quite significantly. So he said himself that policy is pulling in 2 directions. So I think he's very uncomfortable, and we know that he's uncomfortable with the size of the bank's balance sheet, and this is just making that issue worse.
And Christine, just briefly, before we wrap this up, your views on what we saw. It was remarkable, I thought, to see US equities falling on the back of these comments from Andrew Bailey in DC yesterday. What does that tell you and investors about the linkages and the concerns between what is happening in the UK markets and broader global markets?
Well, Tom, I think we can all see that the world is watching what's happening in the UK and perhaps taking lessons. This is essentially what happens when you have fiscal policy going one way and then a monetary policy going the other, and also all the uncertainty that it creates when all these institutions are kind of U-turning on themselves, right? And, you know, the IMF itself has singled out the UK as essentially this is how you should not navigate a crisis. We heard yesterday from their chief economist basically saying that, again, it's that kind of clash between fiscal and monetary policy that the UK really is getting wrong at this particular juncture. And I'm sure the world is watching. You know, it's a country navigating several crises on various fronts, and how the UK fares it will probably reverberate in terms of kind of lessons learned for other economies kind of going through similar things.
Yeah, thank you both for joining us. Bloomberg's Christina Keenan and Dan Hansen from Bloomberg Economics. Also, Columbia Threadneedle halting withdrawals in around £453 million of a UK fund. And we're not even talking about Chelsea. They won against Milan 2-0.
I'm just going to totally ignore that part.
Market turmoil.
But
can't talk about Chelsea.
But what a shame we can't talk about Chelsea. By the way, Arsenal's still top of the league. This whole thing reminds me, I'm teaching my daughter how to ride a bike, and it's like you put the stabilizers on and then you take them off again, and then you put them on again, and she's wobbling all over the place. That's just what I keep coming back to when I'm thinking of the way that the Bank of England is addressing these market risks. That's
such a McKenzie move. Talk to gilts, about gilts to a 6-year-old. Coming up, we'll have more market reaction with Schroders Chief Investment Officer, Johanna Kirkland. This is Bloomberg.
they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Welcome back to the Open. We are 15 minutes into the European trading day. You're seeing losses of 0.3% across the European benchmark. Futures, though, still holding up. Stateside, S&P E-minis up 0.5%. Just drawing your attention to the pound, currently trading at 110. That's a gain of 0.5%. Gilts, though, yields are higher, 3 to 4 basis points on the 2s and 10s on the back of this reporting from the FT that officials from the Bank of England have suggested that possibly they may extend this program beyond Friday. Francine.
So another volatile day for UK assets. That's probably the understatement of the week. The pound moving on conflicting reports on whether the Bank of England will continue its emergency intervention beyond the Friday deadline. Well, Johanna Kirkland is Chief Investment Officer at Schroders. Johanna, thank you so much for joining us. I mean, there's so much going on with the UK assets, and it's really repricing global bonds. What do you think the Bank of England wants to do?
Well, I don't think it's a question of what they want to do. I think, unfortunately, in this environment, there's no easy choice for any central bank. But I think that ultimately they do need to offer a more open-ended commitment to the gilt market.
There's an argument that the British government, under Prime Minister Liz Truss, has lost credibility with the markets. Are we now looking at a scenario where the Bank of England has also lost credibility?
Well, I think that there's an acute problem right now, you know, with LDI, which requires some intervention from the Bank of England. You know, they do need to act as a circuit breaker here. I think then there's a more medium-term issue about the credibility of fiscal policy and monetary policy. But I think that that is something that we can deal with separately if we get through this acute phase right now, allowing the LDI funds basically to reshuffle their positions and get into a lower risk situation.
Do you think that the credibility of the Bank of England is on the line? And is it because of the reversal from BOE officials of what they'll do on Friday, or just the idea that they can remove the backstop in 3 days and markets are fine?
Yeah, I think the idea that you can sort of put an end date on Friday, I think, does lack a bit of credibility, because ultimately we don't really know, that there's more repositioning that's required. But I think that, again, we need to acknowledge the challenges faced by the Bank of England. I mean, one could worry about their credibility, but ultimately we are in a much more difficult world. The trade-off between growth and inflation has deteriorated all over the place. It's particularly acute here in the UK, but partly for reasons unrelated to the Bank of England. And so I think in some terms, I'm not saying we have to cut the central bank some slack, but we need to recognise that we're in a much more difficult environment for them. And compared to the last 10 years, as I said, there's no easy choices.
Do you have faith that they can contain this crisis at this point?
Yes, I do, actually. I believe they can. Okay. But unfortunately, with this kind of political situation, and we've seen this before, we saw this with the sovereign debt crisis in Europe, you know, a decade ago. Unfortunately, things often need to be taken to the brink for us to see action.
But as an investor, why would you not move your money elsewhere? And we did see, I know the Bank of England got a lot of applause because it was the first central bank saying, like, we don't know what we're facing. They talked about 5 quarters of a protracted recession, and at the time, a lot of people said, "Well, this is finally a central bank that was very honest." Are you fully invested in the UK, either gilts or stocks?
No, at the moment we're not. But I would say, first of all, if you think about the equity market, I mean, the weakness in sterling is actually a very important shock absorber for UK profits. So actually, I think the UK equity market looks quite attractive now on a global basis, and so I don't think that is necessarily tied up with the challenges of the gilt market. With the gilt market, we have, in the short term, a very acute problem with the need for the LDI funds to reposition themselves. But I think over the medium term, there could be a level at which it starts to look interesting again. I mean, it's not something we're getting involved in right now.
Okay, but UK equities are looking attractive
Yes.
on some measures.
Yes.
Presumably that takes you to the FTSE 100, the big cap.
The
names.
FTSE 100, yes, absolutely.
What within that space specifically would you be looking at? Without pressuring you to name names, but which sectors, which areas?
Well, I mean, I think that without going into detail of the sectors, the interesting thing about the FTSE 100 as an index is it's quite a defensive index in a global context. And I think one of the things that we're quite focused on now is a risk of recession in the US and in Europe as we head into 2023. And in that context, a market like the UK, which is quite defensive with a cheap currency, actually looks quite attractive.
What will halt dollar strength, and what are the unknown unknowns that it does to other parts of the market?
I think, unfortunately, for dollar strength to really end, you need to see the rest of the world recovering more strongly than the US. I think we're somewhere away from really seeing a reversal in the fortunes of the dollar. So, unfortunately, for now, I think that we're still in a strong dollar environment.
I didn't mean to cut you off
That's
there.
all right.
And I wanted to get your view more broadly. You've talked about your optimism, relative optimism around UK equities. More broadly, global equities, what would you need to see to turn bullish?
I think the problem we're having, so first of all, this is obviously a rate-induced bear market. We're starting to see more realistic expectations priced into the bond market in terms of the extent to which central banks will have to raise rates. So things are improving from that perspective. But I think ultimately for equities, we then also have the challenge of likely recession. And really, we would like to see capitulation on corporate earnings expectations. So a lot of damage has been done already. That's the good news. I think there's still a little bit more to go. You know, we just need to price in a little bit more pessimism before we can really just shut our eyes and buy.
What's your I don't know whether, the biggest dislocation also came from what we saw with OPEC, and whether, the foreign policy is back in the full fold, but also we could see maybe China falling off the brink in a global recession, which is why OPEC decided to cut.
Yes, the challenge we have at the moment is, in some sense, you have different branches of policy working against each other. So we have the challenge of, loose fiscal policy working against the central banks who are trying to curb inflation. And then on the other hand, we also have OPEC cutting supplies. So this is the challenge we have. That's why we're still quite cautious on markets. We're sort of trying to work out what the new equilibrium is. And as I said, we've seen quite a lot priced into markets, but ultimately we need to adapt to a new normal now in terms of policy, which is, again, not something we've seen in the last decade.
Okay. Johanna Kirkland, Chief Investment Officer and Co-Head of Investments at Schroders, on adapting to this new reality, which is a challenge to say the least, but maybe some opportunities in UK equities with that defensive tilt and the benefits of a weaker pound. Right, coming up, recession risk. President Biden downplays the chances of a downturn in the US, but not everyone is convinced. We're going to get the thoughts of Maria Manucci from M&G. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Strong enough to stay, we will never.
Welcome back to the Open, everyone. 25 minutes into the European trading day. You can see we're seeing quite a lot of volatility. The pound actually rebounded. And so I would say a lot of the stories happening in currencies, maybe not in European stocks, but it is engulfing overall worldwide. Of course, some of the questions about inflation and, of course, on this reversal. Was it a reversal from the Bank of England? Do they actually need to extend QE? Now, let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. LVMH shares have jumped despite fears of a global recession, with the world's biggest luxury group benefiting from wealthy American tourists shopping in Europe. The owner of Louis Vuitton and Christian Dior reported third-quarter sales of fashion and leather goods up 22% on an organic basis. Intel is said to be planning job cuts, possibly in their thousands, as it looks to lower costs and cope with weakening demand for personal computers. Bloomberg understands the layoffs could be announced as early as this month, around the same time as the company's third-quarter earnings. That's your Bloomberg Business Flash. Tom, Francine?
Alice Atkins here in London, thank you. Coming up, credibility at risk. Andrew Bailey's pledge to end gilt buying sends markets tumbling. That's before an FT report earlier suggesting otherwise, giving the pound the boost that we're seeing currently in these markets. Sterling is up 0.5%, trading at 110. Gilt yields, UK gilt yields, currently unchanged on the 2-year. You're seeing a move higher, just 2 basis points on the 10-year at 4.46. We keep across this story for you, of course, throughout this hour. Stay with us. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Welcome back. It is the BOE bamboozle. The redhead across the terminal, a BOE spokesperson saying that the bond buying scheme will end on Friday. Pushing back, it seems, on the reporting in the Financial Times this morning, suggesting that BOE officials had suggested to the FT that, in fact, there have been conversations about extending it. The redhead from the BOE, a spokesperson saying that the bond buying scheme will still end on Friday. Let's check in on these gilts. Currently, yields up just 1 basis point at the front end. The 2-year trading at 4.30, the 10-year up 4 basis points, and the pound currently at 109. So pairing the gains. Just a few seconds ago, we were talking about the gains of 0.5% for the pound. That has been wiped off. It's currently trading at 109, Francine.
Yeah, it's pretty incredible what we've lived through. Now, we were talking yesterday about if you're going to stop the fever that subsides in gilts, the Bank of England probably needed to do more and needed to persist with the backstop for certainly more than Friday. So yesterday, the governor said he will stick to his plan to end this on Friday, and I have to say there was a bit of wildness on the markets. Then there was contradiction from BOE officials, this according to the FT, so this is getting back on track. But this, could also pose a credibility problem. I don't think the credibility problem is saying one thing and then the other. It's the fact that they seem to say, look, the markets just need to adapt. It's 3 days, and some of the adjustment could be quite aggressive, unless they know something that we don't, which is the possibility of what Dan Hansen was saying.
Indeed, yeah, that's what Dan was saying, and also the conundrum, the central conundrum for the Bank of England, of course, which wants to, at some point, and it's penciled it in for the end of the month, start quantitative tightening, whilst at the moment still buying bonds. It says it's going to end that part of it on Friday, and then, of course, we look ahead to November the 3rd and the rate hike decision from the Central Bank of the UK. Let's bring our next guest then, Francine, for more analysis on this.
Sir Powers, head of inflation trading at the Bank of England, so no better person than Sam to speak with about inflation and gilts. So what do you think the Bank of England sees that markets maybe don't? If the cutoff point is Friday, what are you going to see in gilts and some of these inflation-linked bonds from now until Friday?
Hi, good morning, Francine. My name is actually pronounced Shemin Shohar Power. Thanks for having me on. So I completely agree. There's confusion in the market following the comments we got yesterday evening, and then this morning. Again, there were some reports that Bank of England might actually listen to the pension funds, and if their deleveraging flows are still continuing, that they might extend the program. Which from a market participant's point of view made sense because here the aim is actually financial stability and to avoid disorderly price action. So we do not want to see forced selling trigger new levels in the market and create more volatility. We know that this program still needs to be clarified. There's some confusion in the market because obviously Bank of England was in the process of tightening financial conditions with rate hikes, and they already announced QT, which had to be postponed. So they are trying to differentiate this program as a temporary program, but still, if the financial stability concerns are there, if the diverging flows are not over, We will still, of course, continue following the communication between pension funds, LDI accounts, and the Bank of England. But yeah, there's a bit of a confusion in the market. And since the news came out that they plan to end the program, we are actually seeing selling pressures again on the very long end.
Yeah, indeed. And to your point, an 11 basis point move on the long end, the gilt, the 30-year, that is the reflection right now. And the pound erasing the earlier gains that we'd seen, currently trading at 109. The FTSE 100 is also lower by 0.4%. The FTSE 250 dropping almost 2%. That's the lowest since May of 2020. The market reaction then post Friday, what is your take on just how high these yields go?
I think there are two issues on one point. So the market participants have been discussing for quite a while now, have we seen the peak inflation, and does it mean peak hawkishness, and will the fall in headline inflation, which we expect to continue, give the central banks a chance to soften their message and maybe hike at a lower pace. And we are even priced for rate cuts in the US at this point. But looking at the underlying inflation dynamics, actually, we are still seeing further pressure for terminal rates to be revised higher rather than lower and a central bank pivot. For example, for the US CPI, which will come out tomorrow, we believe the peak in headline print is actually now behind us with 9.1% print, which was the June print, which came out in July. And tomorrow we are expecting to see a pullback in headline inflation to 8%. But at the same time, we still see strong underlying inflation pressures, and we are still expecting to see an uptick on the core CPI levels to 6.5%. So again, last Friday, the labor data we got out of US again showed that unemployment levels were still falling, participation rate is still falling, labor markets are globally super tight. We haven't seen unemployment levels as low as where we are now in Europe as well since the inception of Euro. So again, from an ECB's point of view, while they keep telling us that the neutral rate is in the 1 to 2% range, market actually sees neutral rate closer to 3%. And if ECB wants to tighten financial conditions as well, as we are at 10% headline inflation at this point, we believe that, again, they will need to hike rates beyond 3%. And again, the terminal rate projections in Europe can be revised higher as well.
Thank you so much for joining us, Shemin Shorer-Power, there, head of inflation trading at the Bank of Ireland, Tom.
Okay, coming up, a corporate story to focus in on LVMH sales soaring despite fears of a global recession. We're going to break down the results and what they mean for the luxury sector next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
A
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Well, welcome back to the Open, everyone. 39 minutes into the European trading day. We had about 6 minutes ago, of course, those headlines from the UK. Tom McKenzie was bringing those to you. The Bank of England saying that the bond buying scheme will still end on Friday. This is about, of course, a bit of confusion after there was an FT headline saying that officials had said that they would be able to support the bond market. I have to say the market is not really taking solace in this, because if the UK bonds extended the fall after, once again, the spokesperson of the Bank of England saying that the scheme will end on Friday. That could mean, Tom, huge repricing from now until then.
Yeah, and we're starting to see a bit of that now across the gilt markets. Yeah, absolutely. Focused on that Friday deadline that the BOE have now reiterated. The long end, that's where most of the action is at the moment. So a move higher by about 10 basis points on the 30-year, the 2-year here in the UK, currently unchanged. The 10-year, that's a move higher, and close to 5 basis points at 4.48 on the 10-year. And again, the pound, 109, currently just up 0.1%. It had been up as much as about 0.5, almost 0.6% earlier in the session before that redhead crossed from the Bank of England. Let's get back to one of the big corporate stories of the day then, a little bit of optimism when it comes to the luxury space. And LVMH sales have jumped despite fears of a global recession, thanks to wealthy American tourists shopping in luxury in Europe and shopping with a bound with those strong dollars. Sales of LVMH's fashion and leather goods soared 22% on an organic basis in the third quarter, beating analyst expectations. Let's bring in then Deborah Aitken, luxury analyst at Bloomberg Intelligence. Talk us through these numbers and what it says about the resilience then of LVMH and the broader luxury sector, Deborah.
Yeah, so 19% growth in the Q3, matches Q2, beats significantly versus consensus, and you get double-digit growth in every category in the Q3. What it says, fashion and leather goods, prices are higher. You know, if we look at Louis Vuitton, Dior, over the last 3 years, we've seen about a 20% price hike, and that will continue into 2023, 4, 5, 6% per year, as is needed, but costs are quite low. So overall, the market is buoyant for these kinds of categories.
Deborah, so 20% of price increases, does this just go to their margins, or is it because they themselves have had to pay more for the raw materials?
So 20% over 3 years, so we average about 5 to 6%, and that's partly on mix, it's on new collaborations, it's on different kinds of product within the category. It also backs wage costs, it backs costs of goods, but generally their costs of goods are very low. We look at margins over 70% across this sector at the gross level. So they have relatively low cost base, and we know that most of it is in euros, so they're benefiting on FX.
All right, Deborah, thank you so much. Deborah Aitken there, luxury analyst at Bloomberg Intelligence. Now, NATO defense ministers are gathering in Brussels for a 2-day meeting as Ukraine calls for more military equipment following a series of deadly missile strikes by Russia. Meanwhile, the NATO Secretary General Jens Stoltenberg warned this is a crucial time for transatlantic security and reiterated the alliance stands by Ukraine.
For more, we're going to go to Maria Tadeo, who is following and has been following, of course, the meeting at NATO's HQ. Maria, the war, we know, of course, has escalated again this week. How will, and what is your sense of how NATO allies are preparing to respond to Russia's escalation?
Yes, and Tom, there's two things the NATO Secretary General will put on the table today in this meeting, once again in the shadows of the war in Ukraine. And one, you talked about escalation. He will refer to that and almost signal inevitably allies have to either step up or accelerate their weapons deliveries for Ukraine, particularly now when it comes to the air defense systems. If you look at Monday, which was a Black Monday for Ukraine, 84 missiles were fired by the Russian Federation across the Ukrainian territory. It seems that once again, the tactics of the war are changing from the ground to the skies. And then the other big issue today, particularly in light of that report by Polish authorities that there has been a leak in an oil pipeline, is how to protect critical infrastructure. And the NATO Secretary General had a warning saying Russia should really understand that going after a critical infrastructure will be met with a firm and united response.
So important, isn't it, as we watch what happened in Germany with some of the transit there, as of course we reflect on what happened with those Nord Stream pipeline explosions, and now not necessarily linked, but we are of course monitoring what's happening in Poland, as you say. Maria Tadeo live at the NATO HQ, and continuing that story around the leak in Poland, again reporting that there has been this leak at the Druzhba pipeline, which carries oil from Russia to Europe. Polish pipeline operator PERN says it is unclear what might have caused the leak. For more, let's talk to Bloomberg's Andreas Kluth. Andreas, what do we know at this point, and tie that in to your reflections as to the risks around Moscow and the calculations from Putin when it comes to potentially sabotaging European infrastructure?
As far as the new incidents in the Polish pipeline, we know nothing, or at least I don't know anything. And that's part of the nature of hybrid warfare, which Putin is an expert in, which he's been perfecting. He's a KGB-trained warlord who's been practicing hybrid warfare for many years and is clearly increasing them now. But it's in the nature of warfare that it's ambiguous fighting, that it's hard to have the normal attribution that you'd have on a battlefield. And so we get and will get an increasing number of very suspicious incidents. You mentioned the train outage over the weekend in Germany. You know, when two cables hundreds of miles apart were cut simultaneously, one the backup for the other. There have been the explosions under the Baltic Sea for the Nord Stream pipelines. There were cyber attacks against U.S. airports yesterday. And now there's this Polish pipeline, and there will be more. I think we should expect that our satellites will start behaving strangely, or our GPS systems could go down, that there'll be power outages. And this goes alongside years and now increasing amounts of disinformation, the seeding of conspiracy theories and Manchurian candidates, and of course, everything up to little green men and the full-on official military thing, and this is what we call hybrid warfare. And Putin is a master of this. We know he's doing it. NATO has, since 2016, had a policy that in certain instances, Article 5, an attack on one as an attack on all, could be invoked in response to hybrid warfare too. I think we're getting uncomfortably close to that, but I think we should be under no illusion that he's doing this, even if each individual incident is almost impossible, at least in the short term, to prove the connection.
Right. So, Andreas, first of all, what could this mean for Europe's energy security? But is there also any way that the West can protect themselves for such small attacks?
Europe's energy is not secure and hasn't been. We're flailing and we're doing our best, okay? In terms of what the West can do to prepare. First of all, the West can stay united. It can, NATO and the West, we know Putin's vulnerabilities too. We can play the game of hybrid warfare too. So it's not an all or against nothing that he does hybrid warfare against us, and we have to, in one step, escalate to essentially a World War III scenario where we retaliate. It can be covert in both directions. These plans are underway, they're being war-gamed, and we have to be very careful with the escalation ladders right now. But the West can defend itself. And by the way, NATO has already doubled, I believe, the presence on the North and Baltic Seas, because there are lots of other cables, from internet data to electricity to gas. there, and they're very vulnerable. But there's not, at the end of the day, it's happening, and we have to be prepared for more of it.
Okay, Bloomberg Opinions, Andreas Kluth with a very prescient piece out earlier this week on the infrastructure challenges and the potential risks with that analysis. Thank you, Andreas.
Coming up, the Bank of England stands firm, saying its emergency intervention will end on Friday, despite conflicting reports. We'll analyze what that means for gilts. For the moment, UK gilts falling as the BOE once again confirms that the end of bond buying is this Friday. This is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Welcome back to the Open. We're 51 minutes into the European trading day. This is a picture for equities, but it's all really happening in gilts. It's all happening in sterling. Gilts definitely on the move. UK gilts falling. The BOE just moments ago confirming that they will still end bond buying on Friday. So it's reiterated its plans to actually finish this on Friday, despite a conflicting report that it could be extended. So joining us now is our gilt guru. He is Ven Ram from our Markets Live team. Ven, first of all, thank you so much for all of the time you take to actually explain to us exactly what's going on in the gilt market. So we talk about a huge mistake, one of the biggest gaffes in central bank history from the Bank of England. Is this because they want to end this bond purchasing on Friday? Or could it be that they think the market can handle this? 3 days to go and they can work through this?
I think it's the latter, Francine, but I don't think they are reading the market right, because we have seen yield surge in the past week alone. And if you look at the 30-year yield, which is the key metric that we need to be watching, the 30-year yield is at 488 as we speak. And that is not too far away from the peak that we saw before the BOE unveiled their actions. So if the 30-year yield climbs back above those levels, and there is volatility all over again, and if the BOE is going to end their purchases this Friday, and then we've got 2 more weeks to go before the BOE scheduled BOE meeting. So it is setting the market up for yet more volatility and yet more uncertainty, which definitely is not something the central bank would wish to have.
Ben, is it your analysis that they can actually hold the line on this, that they can really pull back on Friday, or are the bond vigilantes, as some describe them, actually going to force their hand ultimately?
Absolutely, Tom. I think that the market has the upper hand in all this, and I think it's for the BOE to propose what it wants. It's for the markets ultimately to dispose what the BOE says. It's not in the BOE's court anymore. It is for traders to decide whether the BOE's actions are so far sufficient. If the LDI community finds themselves in a position where their positions are not yet fully adjusted to the new reality, then we may get that volatility all over again, and the BOE may be forced to come back into the market, maybe not in terms of bond purchases, but they may have to do an emergency rate hike. And we know they are very reluctant to go down that path. So the BOE can't be dictating terms to the market at this point when the market seems extremely vulnerable. We have already seen sterling pull back. We are seeing gilt yields climbing higher this morning. So this is not a situation that BOE wants to find itself in.
Yeah, but Ven, to cut actually the Bank of England a bit of slack, and I don't know whether we should or not really at this point, but it does feel like its remit is now 100% political because of what's happened with the government and the mini budget. So is there a case for saying actually the Bank of England is right in saying Friday's the deadline, that's it, get your act in order?
Yeah, the BOE is absolutely right. I mean, from a principal point of view, the central bank has no reason to be in the market buying bonds at a time when it is also going on with persisting with QT and rate hikes. It sends a conflating message about the direction of policy. But, you know, as I said, there are political ramifications to this, and it's not clear in which direction monetary and fiscal policy are acting in the UK anymore to anyone. We've got fiscal policy loosening, we've got monetary tightening, and now we've got the Bank of England buying bonds in the bond market. So it's all over the place, and policy messaging is anything but coherent.
Yeah, anything but coherent. Ven, you are very coherent, fortunately. They're going to end, they're not going to be able to go ahead with QT on October the 31st, are they?
Likely not, but I don't think the Bank of England, if the Bank of England is talking tough about holding the line on Friday, I don't see a reason why they cannot go ahead with QT in October, at least theoretically. Well, from a practical standpoint, maybe they need to pause the purchases, pause the selling, if this volatility continues. So it's all going to come down to this 2 weeks of volatility that we are going to see before the BOE's November 3rd meeting and the end of purchases, scheduled end of purchases this Friday.
Okay, Bloomberg's Ven Ram walking us through the market reaction from the flip-flopping, arguably, from the Bank of England. Thank you very much indeed, checking in on these gilts. And in fact, the action is a little bit more muted now. You've got yields down by about 9 basis points at the front end on the 2-year, currently trading at 420. A bit more action at the back end, the 30-year currently at 485. That's a move higher by close to 6 basis points in terms of 30-year gilts. Francine.
Now that's it for the European Market Open. Surveillance Early Edition is up next. I have actually an interview I'm really looking forward to, and that's with the NatWest chair. He's Sir Howard Davies. He was also deputy governor of the Bank of England in the 90s, so he understands mortgages, he understands gilts, he probably understands also the inner workings of the Bank of England. So that's the person I'm most looking forward to speaking to a little bit later on. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Standing firm, the Bank of England reiterates plans to end its emergency intervention on the bond markets on Friday. That follows uncertainty in the markets after conflicting reports over whether Governor Andrew Bailey would extend the emergency deadline. We'll speak to the NatWest Group chairman, Sir Howard Davies, later this hour. Plus, recession risk. President Biden admits a downturn is possible. The president also says Saudi Arabia will face consequences for the OPEC output cuts. Now, first thing is first, it's all happening on the markets and certainly all happening in the UK. Now, we did have confirmation about 20 minutes ago that the Bank of England will go ahead and stop bond purchases on Friday. A lot of people saying this is a mistake, it's a gaffe because we're not 100% sure whether the market can handle it. Others saying, look, maybe they see something out there and it's the right time for them to work through it. The pound actually swinging to a gain when we had that financial report, also BOE officials saying that they could be a lot more flexible. So for the moment, sterling actually at 109.80. The UK 30-year yield, remember, this is the reason why we had quite a lot of movement and worries about margin calls on pension funds, currently at 4.878. Dollar index, it is also a dollar strength story. And when you look at European stocks, they're pretty much unchanged, maybe a little bit on the lower side. S&P 500 futures gaining some 0.4%. But I would really watch these two things very, very closely. When it comes to the European map, we're seeing quite a lot of red on the screen. I was looking at the industry groups that make up the 19 S&P 600, and there is almost losses across the board with, for example, the FTSE down 0.2%. So the Bank of England has confirmed an end to the bond buying program on Friday in an emailed statement. That's after the FT reported this morning that the central bank was privately signaling to bankers that it may extend buying yields. Now, the Governor, Andrew Bailey, spoke in Washington yesterday.
We've announced that we will be out by the end of this week. We think the rebalancing must be done. And my message to the funds involved and all the firms involved in managing those funds, you've got 3 days left now. You've got to get this done. Because, again, part of the essence, I think, of a financial stability intervention is that it is clearly temporary.
Joining us now is Dan Hansen. He's senior UK economist at Bloomberg Economics, and Christina Kino from our markets team. So thank you both for joining us. Christine, I mean, the markets were really whipsawed as we try and understand what the Bank of England is trying to tell us. And it's clear that now they want the program to end on Friday. Is that a mistake, or do they actually think the market can work through this?
Well, Francine, I think as we've spoken about before, the mistake here is probably delivering that absolute message that they are definitively ending it. Because as you mentioned, we don't know the market can handle it. And what happens if, in fact, they need to U-turn back on themselves and say, actually, hang on, we're going to have to do another round of intervention or maybe extend this current one. And, you know, that all really just goes back to the question of, can the markets trust the BOE to ease at least the acute and imminent pressures that we're seeing in the market? With this sort of development recently, it seems like more and more the answer is maybe no.
Yeah, and this is a market perspective, but then from a purely economics perspective, so it's also the Bank of England saying, like, look, we've become now very political because this bond route was basically started by the mini budget, and it's philosophically difficult to, you know, keep on buying bonds when you're raising interest rates. Is that the message they're trying to get across?
I mean, that's absolutely right. So I think what the bank is trying to steer clear of is linking what it's doing to this fiscal statement that we've got on the 31st of October in particular. And we've got that date as well is key in investors' minds, because that's when the bank has said it's going to start QT, active gilt sales, as well. So there's a lot going on at the moment. And I think Bailey, one thing that is on his mind is to this idea that monetary fiscal interaction, fiscal dominance, but also the fact that he's doing this, and the Bank of England is doing this QE, and it's pushing against the idea of reining in inflation. They're doing QE, but they want to raise interest rates as well. And that's a really, just within the bank, forgetting the fiscal side, that's a big tension that he's trying to step away from.
I mean, if we take a step back, what's the role of central banks? I know, again, this is called a gaffe, and it kind of brings us back to what Christine Lagarde, you know, made that gaffe in saying we're not here to close bond spreads. But is it, you know, they look at financial stability, they look at that 2% inflation target. Should they be really worried about the bond market right now and keep the option open? Because it doesn't focus the mind of bond traders.
Yeah, I think that really is it. The kind of like focusing the markets on whatever it is that they're trying to achieve at this particular point in time. I mean, as Dan was saying, the overall trajectory and the ultimate goal of the BOE was meant to be fighting inflation, and they were on that path with the multiple rate rises that we're seeing and probably are about to see. But then there's this sudden kind of shift toward the financial stability issue, which is more kind of in your face and more acute, but that's also part of their responsibility to address. But again, Governor Bailey was very insistent this is temporary, the support that they're providing. It's just a matter of whether bond markets are kind of, you know, do they have the same definition of temporary, I suppose, is the big question.
But Dan, at the end of the day, are they there to kind of help out bond markets no matter what?
Well, I mean, I think the answer to that is yes and no. I mean, in the sense of the financial stability intervention that they've done, it's very specific. It's meant to be very targeted. And he's come out and said they were looking to come up with a targeted measure, but they just couldn't. So they've gone with this blanket approach. But ultimately, the bank is trying to transmit its policy through the bond market to the real economy. So there is they've obviously got massive skin in the game with this. I just think what Bailey has said is that he's trying to draw this very fine line between monetary policy intervention through QE, which is blanket buying of bonds to get to a big target of bonds, and this very specific intervention that he deems necessary, but also thinks needs to end sooner rather than later, and they need to get out of the market.
I mean, you said something that really struck me last time. I mean, maybe they're seeing something that we don't, right? Maybe they do think, because they have, you know, their finger on the pulse, we hope, on what bond traders are doing. They think that the pension funds can handle this.
Yeah, I mean, I think if you look at the press notice yesterday, they made a point that the liquidity position of pension funds and LDIs in particular has improved. And I think they feel, or they may have been seeing this improvement there, that they feel that Friday is okay for them to step out. I mean, the big thing, and Christine mentioned it, the big thing here is that it may not be LDIs that blow up next. It may be some other pocket of instability that breaks out. So I think there is something to be said for them on Friday, giving a calming message, saying, look, we're exiting, but we're here. If something blows up again, we're going to be here. And I think that's probably the path of least resistance, at least for markets.
Christine, I mean, the other story is actually Columbia Threadneedle halting these withdrawals from UK property funds, about £450 million. Is that significant?
Well, I suppose it's significant in the sense of this is the spiral effect that we're seeing, right, as an effect of the initial LDI crunch that we saw a couple of weeks ago. And, you know, the lines from our asset management reporter very much ringing true. Now we're seeing kind of this ripple effect of various asset sales rippling across the UK market. And what is that going to do? I mean, Dan mentioned, again, it may not be specifically one pension fund blowing up, but then what is that going to look like in other ways? You know, we could see mass just declines in various asset prices, whether it's, you know, in public markets or, as you mentioned, you know, some of these like property funds, very specific asset or alternative asset funds. We just don't know at this point, but there is that danger of the ripple effect that could once again put the focus back on financial stability.
And the Bank of England is getting so much flack today, really, from everyone. I mean, I think Governor Bailey is also on the front page of The Guardian saying, like, kind of, what are you doing? What are you thinking right now? They were the first central bank to come out and saying, you know, 5 quarters of protracted recession is possible. They were very upfront about the risks in the markets, and certainly they kind of warned the government of what we could be facing. When do we know whether this was a good or bad thing? You need to let it play out first, or on Friday do we say, actually, this was a mistake?
No, I mean, I think the real interaction here was with the government and what they say on the fiscal side. So it might be that it looks like a stroke of genius come the 31st of October if the government manages, and it's a tall ask, to set out a credible fiscal plan. But I think what people are really worried about, and markets in particular are worried about, is that 2-week period that we've got between the 14th and the 31st. And that's where I think there's just this desire to have a bit more of a backstop from the bank rather than just exiting stage left and saying that's the end of it. So I think this could look like a success. It really could, but it really hangs just as much on the government as it does on the Bank of England, and that's really where the buck stops. Because all of this, remember, stems from the mini budget, and that's what needs to the fiscal plan and the path of fiscal policy and a sustainable fiscal plan needs to be set out. And if that comes, then things should calm down.
Okay, such a good point. Thank you both for joining us. Dan Hansen, Senior UK Economist at Bloomberg Economics, and Christina Kino from the Markets team. Now, coming up, we're taking a deep dive at the private equity sector. We'll be speaking with Philip Freyser, the co-head of European private equity at KKR, about why he's still optimistic about the sector. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away. The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's talk about the private equity space. Investment firm KKR reports 491 billion assets under management. Now the U.S. company says its European private equity division has deployed $5.5 billion so far this year. Well, my next guest does not believe this is the worst time for private equity, as some have claimed. I'm very pleased to be joined by Philip Freise, the co-head of European private equity at KKR. Philip, what a day to come on. I was going to hound you on UK investments, and actually so you have a very clear strategic plan on what you want to buy. A lot of it is family-owned partnerships across Europe. With all of this mess in the UK, does it make you more likely or less likely to invest here?
No, first of all, good morning, Francine.
Good morning.
It's great to see you on a tumultuous day like this. It is instructive to have invested for 21 years, including the great financial crisis, because what we do is not look for the short term, but to really think about 5 to 10 year horizons. And as Warren Buffett says, at times like this of disruption, you can find great opportunities. So we are constructive at this time.
I mean, would you link this to the financial crisis? I guess what we don't know is that, fairly boring parts of the markets. I'm thinking of like pension funds, 30 years. I mean, it's meant to be boring, Philip. I don't exactly 100% know what happened the last 2 weeks, but you have these pockets of risks coming up where we least expect it.
Well, what's interesting is since the great financial crisis, we have had one period of accommodating monetary and fiscal policy. That's changing now, and that will not be reversed. So this is a new era where accommodation is withdrawn. At the same time, we have a significant event like Ukraine. So we are in uncharted territory in that sense.
So what does it mean for your investments? So if you look at the UK, again, there's a cost of living crisis. I don't know whether it means that certain companies will be distressed, and it means that you could come in and restructure or consolidate, or whether you just need to see this play out first.
So this is a time of maximum uncertainty for many businesses. In Europe, what we have done over the last 15 years, in 80% of all of our transactions, we have actually partnered with either family companies or corporates or entrepreneurs to help them navigate through that uncertainty with a truly global platform that KKR has and a toolkit that helps them become more international, in fact, cope with this energy transition crisis and become more technologically orientated, which is a big focus in Europe. So this is the time to partner with us and do this.
But when you speak to some of the founders or chief executives, what's their number one worry? So I've been speaking to a couple of people, and they say, look, yes, it's a cost of living crisis, it's inflation, supply chains, but actually they don't have enough staff. It's difficult to employ people for the roles they're looking for.
Well, that's an excellent point. If you think about what Elon Musk says, the largest issue we all have is demographic change. So if you think about the fact that in 2050, 1/6 of the world's population will be older than 65 years old. And in Germany, by 2030, we lose 5 million jobs because of that demographic change. It means we are through this secular change, which KKR is investing behind. So aging societies opens many opportunities in healthcare, but also in technology. If you look at Stepstone, which is Axel Springer's largest division, that's exactly what we are investing behind.
How much money do you have to spend in the next 2 years?
Well, as a firm, globally, we have $115 billion of dry powder. As you have noted here in Europe, we really leaned in during COVID, where we invested $6 billion. 21, we trenched a bit because we saw the markets getting really expensive, $3 billion. So far this year, we've invested $5 billion. And, we'll continue looking for opportunities.
I mean, does strong dollar help you? Actually, I mean, we have these quirky stories about, Americans buying luxury apartments in Paris. Does it help you if you're, kind of bring money over here?
So as a macro point, Europe has never been more attractive in our view. Now's the time to invest.
That's a bold call.
But it's not because of the currencies.
Yeah.
Okay. We are long-term investors. We are not currency speculators. But it's because of that disruption I described. Now is the time to partner with families and transform their companies. And of course, valuations have come down.
Yeah. What's the biggest mistake of family-owned companies, which I'd like to remind all of our international viewers? I mean, they can be quite big in Europe. I mean, these are sizable conglomerates. Is it that they're underinvested? Is it that they're not expanding enough? Is it their international strategy or something else?
First of all, they're the bedrock of the European economy. If you think about Germany, for instance.
The Mittelstadt.
Exactly. Yeah. We have 3 times more large family companies relative to GDP than the US. And they're long-term investors. So in many respects, they are like what we do. We think about investments over 5 to 10 year horizons. What you cannot expect from them, given they have been here for centuries, is to really be at the height of what's happening in the world. Technology, life sciences, energy transition. So the knowledge that we have globally is something we can help bring to these European family companies.
So do you think there'll be more companies like that looking to private equity because interest rates are going up and so the cost of funding is more expensive?
Overall, this is a big trend. If you think about private equity today, it's not buying companies necessarily, it's really helping them solve problems. In addition to that secular trend, yes, the current market environment means that capital, especially in the capital markets, is much harder to raise. So as a result of that, private equity plays a larger role in this regard.
Yeah. Phil, we're just getting some breaking news out of Haskell of the Bank of England. We were expecting actually quite a lot of Bank of England officials to speak today and so give us a bit more clues, but he's saying that he will not speak about monetary policy today. You're a huge opera fan, Philip. I mean, if you look at the UK, what kind of opera does it remind you of? That's a trick question on a Wednesday.
First of all, it's important as an investor to have balance.
Okay.
I really encourage everybody who does this job to have something that creates passion in their lives. For me, that has always been music.
Yeah.
I mean, Richard Wagner says imagination creates reality. You think about investing is imagining the future.
Yeah.
So I get lots of inspiration from that. In terms of the current situation, Rheingold is a good comparison.
I like that. We're going to send it over to the Bank of England.
Yes.
Okay, that's fabulous. Philip, thank you so much for joining us. Philip Freiser, there, co-head of European private equity at KKR. Coming up, NATO defense ministers are meeting in Brussels as Ukraine continues to suffer at the hands of Russia. So we'll be hearing from the Latvian defense minister, Jānis Garasson. That's coming up next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, NATO defense ministers are gathering in Brussels for a two-day meeting as Ukraine calls for more military equipment following a series of deadly missile strikes for Russia. Meanwhile, NATO Secretary General Jens Stoltenberg warned this is a crucial time for transatlantic security and reiterated the alliance stands by Ukraine. Now, for more, we go to our reporter, Maria Tadeo, who's, of course, following the meeting at NATO, who's also joined by a minister. Maria, over to you.
Yes, Francine, good morning. And of course, the word here at the NATO headquarters is escalation after a very terrible week for Ukraine. And to talk about this, we're joined by Yanis Garrison, who is the State Secretary for Defense for Latvia. And sir, if we look at the choreography here, you've had the Nord Stream explosions, then you have a Black Monday for Ukraine. 84 missiles were launched against this country on Monday. And today the Polish say we've detected a leak in an oil pipeline. In your view, are we now in a form of hybrid war, even here in the West?
Well, I would say on that day when President Putin announced mobilization and his whole strategy from that point of view, it's escalation strategy. And I think we have to count that there will be even more escalation. And therefore, I would certainly see all actions taken by Russia on that kind of escalatory track. Therefore, also threatening nuclear weapons, the use of nuclear weapons is part of that, but that is probably the ultimate tool what Mr. Putin can use, and he's been, blackmailing. I would put this nuclear, doing this nuclear blackmailing for quite a time. Therefore, before he gets to this nuclear issue, I would say we will see most likely another escalations, and they would be most likely in hybrid terms. And we have to look very carefully on our critical infrastructure.
And you mentioned escalation and potentially attacks on critical infrastructure. So that means, the pipelines and anything that has to do potentially with internet, telecoms, communications. But I wonder, just to make it very clear, if that were to happen, and you look at Article 5 of NATO, how's the response? How does NATO respond to this? Because Article 5 does not make a reference to infrastructure.
Well, I think this Article 5 is a political issue, and the decision will be taken on case-by-case basis. And we've seen the evolution of Article 5, specifically, for example, the cyber. NATO stated very clear that there might be cases when cyber attack is viewed as Article 5. And therefore, I certainly would see also that there might be cases when vital interests of states are threatened, NATO states are threatened, and NATO can step in protecting interests. And therefore, I would look also very carefully on resilience, how we can strengthen resilience on our critical infrastructure. And also, as winter is coming, it's very clear that Putin's strategy is actually to harm Europe as much as possible when it comes to energy. And this probably is his last option to change European views on Ukraine.
And that's a very good point as we head into the winter, the idea that pressure is going up. But just to make it very clear, what you say is you would not be surprised to see if from now to the winter, there's pipelines that no longer work, there's perhaps explosions that nobody knows where they come from. That's essentially what you mean.
Yes, because that, as I said, it's from our perspective, that is the only way how Mr. Putin can affect this situation and turn it into his own favor. Because we don't think that he might change any views of Ukrainians, because they are very determined, and he can't change most likely the situation in front also with big mobilization, because we see that troops are not trained and. Exactly. Therefore, the only way, actually, how he can change the situation is cut Western supplies. And how you can do it, actually, to affecting public mood. And I think the coming winter is probably lakmus test also for NATO or Europeans.
And can I ask you, a lot of the words here, or the word that gets repeated the most, is that Russia has now chosen escalation on Ukraine. He's gone down the path of escalation. That means Ukraine needs more weapons to defend itself. But I wonder, do you fear that perversely that is going to make things worse, or is this the right thing to do? Ukraine needs more weapons, even if the fight gets tougher.
No, I think generally we should not, probably that is important to discuss our strategy here at this NATO ministerial. What will be our strategy towards Russia and also towards Ukraine? Because if we have any doubts about our determination to help Ukraine, then probably Russia already won, at least partially. And I would say it's been traditional Russian strategy to escalate and use this escalatory threat in NATO, certain Western countries, societies. And if we decide to step back and give up our principles, that means Russia won already. And therefore, that will be only a matter of time when, when they will ask something else. That is how Putin's strategy works.
And just as a final question, he has talked about nuclear, saying we're not bluffing. If there is damage done to our territorial integrity to Russia, I'm not bluffing. This is not a joke. In your view, treating this very carefully, is this a real menace? And I guess the real question is, do you have the deterrence from a NATO perspective to stop this from happening?
No, I think NATO has good policy, and also latest NATO statements and US statements made it very clear, and that deterrence work. But looking what happened before, probably this will be his last chance, and probably it's a very low possibility that he will turn to nuclear weapons. But still, I would not exclude probably 100% that it might not happen because we also didn't expect that he might go for a full-scale war, that he won for mobilization and many other things. But I think, therefore, it's important to have very strong deterrent strategy.
Well, and of course, the war did happen, and unfortunately, it continues. Sir, thank you so much for joining us on Bloomberg. Good to see you. Appreciate your time. And that was Jānis Garrison, the State Secretary for Defense for Latvia. Francine.
Maria, thanks so much. Maria, today they're live at NATO headquarters with, of course, a great interview talking about Ukraine and Russia. Now let's get back to our top story. The extreme volatility in the pound and UK bond market has put the country's mortgage industry under immense pressure. Now the average 5-year mortgage on a fixed rate actually soared to more than 6% following the Chancellor's fiscal plans. Now that's the highest level in around 14 years. Well, my next guest is Sir Howard Davies, chairman of one of the UK's biggest lenders, NatWest. He's also former deputy governor at the Bank of England. So, Sir Howard, thank you for joining us. I mean, I have a million questions, first of all, on the Bank of England, because, frankly, the markets are a little bit all over the place. Many operators saying this is a huge communication blunder from the Bank of England, but also in thought they can't end these purchases on Friday. What is going on at the bank?
Gosh, that question surprises me. I thought you'd ask me on to talk about AC Milan's latest home defeat, but if that's what you want to do...
I love Chelsea, so we can also talk about football.
Okay, but if the Bank of England concerns you more, yeah, what is going on? Well, they introduced this facility, which they always said was time limited, and they wanted to allow the pension funds to readjust their portfolio with these liability-driven investment strategies. And I think what they are concerned about is giving the impression that they have one foot on the accelerator and another foot on the brake for an extended period of time. Because on the one hand, the Monetary Policy Committee at one end of the corridor in the bank has said we are going to go for QT, quantitative tightening, withdrawing support from the market. And at the other end of the corridor, the Financial Policy Committee, also chaired by the governor, of course, has said, well, we actually are prepared to do some buying, but they clearly defined that as being related to particular market turbulence and instability. So I think what Andrew Bailey was saying last night was simply that particular scheme comes to an end. That's what it is for. Now, of course, if we have renewed turbulence, who knows? And the central bank will never say never. We will never intervene. But that's what I think, that's how I read what they're saying at the moment.
But are you expecting the markets just to test this and test this and test this until the Bank of England does more?
Well, let's try to unbundle what you mean by the markets. I mean, this is a fairly specific intervention designed for particular pension funds. Now, that's what he is talking about bringing to an end. And he's saying those people who are short of liquidity should use this scheme quickly. There is, incidentally, another scheme that has been announced, which is called the Temporary Expanded Collateral Repo Facility, TCRF. They've not got great marketing people in the Bank of England, I think, but so the TECFRF is open to people to post collateral with banks and for banks in turn to post collateral at the central bank in order to get cash. So there are various routes. Now, of course, there are other market participants who are not directly affected by this, who are just looking at this and saying, look, we don't like sterling assets and we don't like the pound, and therefore I can't rule out, and nobody can rule out the fact that there will be sort of knock-on consequences in other markets.
But so Howard, so effectively this tool that you're mentioning, without the great marketing skills, it's not really a backstop? Is it a backstop when the current backstop on Friday runs out, but it's not necessarily for pensions, it's just for banks to be able to draw into?
No, but it's for clients of banks.
Right. So
we don't need it
fund.
ourselves, but it's for our clients, if they're pension funds. We're not big in this market as it happens, but we do have some clients of that sort who could deposit collateral with us. We in turn deposit at the Bank of England, and we can provide liquidity for them. Not been used so far, but it could be.
So is there a danger in the markets over the next 2 weeks until we also understand what the government's plans fiscally are? And could this be a stroke of genius of the bank saying, look, we stop on Friday because, as you say, it's fairly difficult to take away with one hand and give with the other?
Well, I doubt if even the governor would say this was a stroke of genius at this point because nobody knows what will happen over the next couple of weeks. I mean, you're right to point to the fact that the key thing is some certainty about the government's fiscal policy, and we're not going to get that until the end of the month. So I fear that the next couple of weeks is going to be a bit of a rocky ride. Maybe people can hope that once everybody gets to the IMF, the governor's already there, I'm off this afternoon, that people will start to focus on global economy and big issues, and the UK will perhaps fade into the background. That'd be nice to hope.
But do you think they will, or do investors shy away from the UK for almost years to come because of what we've lived through in the last month and a half?
Well, we'll see. Investors are driven by the possibility of making some profit. At the moment, they say, many of them, UK is too uncertain. I've heard people bandy around UK is uninvestable at the moment. These are sort of words that investors like to use, but they will look at, but it looks as if we're having a sort of repricing of UK assets via the fall in the exchange rate. At some point, they'll be attractive to people again, but at the moment, it's a bit difficult to entice people into UK assets, and we're seeing that in the fall in the equity market.
When do you think the UK will be attractive again? And I mean, I've heard investors say, well, this is behaving like an emerging market. I'm getting the hell out.
Well, I think the key thing is whether the fiscal strategy that is produced at the end of the month is one that is credible. And then what happens to the UK economy. I mean, at the moment, we're the only one who hasn't got back to pre-crisis levels, which is unusual. Some of that's Brexit, I would think. So I think there'll be two things. One, in the short run, is the fiscal strategy credible? And then secondly is, in the impending recession, which I think everybody now pretty much expects, is the UK hit worse than other people, or do we just sort of ride down with the crowd?
Do you think the credibility of the Bank of England is really at play now? Or, again, they've been dragged into this political mayhem, and it's difficult to see a way out?
The bank has been played into a very difficult position, I think, as a result of this hiatus, if you like, in policy making. And so, they're left holding the baby, so to speak. And so I have quite a lot of sympathy with the bank. Maybe as an ex-deputy governor, you'd expect me to say that, but I do, because I think they are trying to hold things together as best they can in something of a policy vacuum, and that's never a great place to be for a central bank.
Where do you see the UK headed economically? So you have very recent data at NatWest trying to understand how consumers are spending, what mortgages are doing. What do you worry about the most?
Well, one of the things that does concern me is that I think we have been talking ourselves into a worse state of mind than perhaps we are. If you look on the good side, you've still got rather full employment. Now, some of that's to do with what's going on in the labour market, which is tricky. But we're still seeing people with a lot of deposits. Our deposits in our bank went up last week. I mean, strangely enough, we're still seeing strong spending on holidays, and leisure spend is strong. We're not seeing very much in the way of distress among consumer borrowers. Mortgages are still available. They're at a different price, which obviously is not welcome to people, but they're still available. So I think we're at risk of talking ourselves into a worse position than we are. This is not yet looking to me like a very steep and deep recession. It's looking like an adjustment to an unfavorable development in the terms of trade, because energy prices have gone up significantly, and we are having to adjust to that.
Sir Howard, thank you so much. We'll have plenty more from Sir Howard Davies, chairman of NatWest Group. That's coming up shortly, and this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. LVMH sales have jumped despite fears of a global recession, with the world's biggest luxury group benefiting from wealthy American tourists shopping in Europe. The owner of Louis Vuitton and Christian Dior reported third-quarter sales of fashion and leather goods up 22% on an organic basis. Now, Intel is said to be planning job cuts, possibly in their thousands, as it looks to lower costs and cope with weakening demand for personal computers. Bloomberg understands the layoffs could be announced as early as this month, around the same time as the company's third-quarter earnings. Now, the U.S. Justice Department is investigating whether Credit Suisse continued to help clients evade taxes years after it pledged to actually tackle the issue. The latest probe comes 8 years after the bank paid a $2.6 billion settlement in the U.S. Credit Suisse denies any improper conduct and says it is cooperating with authorities. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Leanne Gerrans there with the First World News. Now, let's get straight to Sir Howard Davies. He's chairman of NatWest Group to talk about mortgages, the UK, the Bank of England, and, of course, the gilt market. Sir Howard, thank you so much for staying with us. We were talking a little bit about some of the refinancing plans of the LBIs and pension funds. Do you worry about, first of all, of money going into even more into shadow banking, a space which is unregulated, and is that where the next crisis is coming from?
Yes, I mean, it's not totally unregulated because the Financial Stability Board have done a lot of work on trying to get at the shadow banking sector via funding from regulated entities, for the banks, etc. But undoubtedly, there is a lot of maturity transformation that goes on inside the shadow banking sector. That's inherently risky. The squeeze on banks via ever-increasing capital ratios gives people an incentive to go to shadow banks for credit because it can be cheaper. But of course, they fund themselves frequently in relatively short-term markets. So yeah, if I were at the central bank today, I would be casting a beady eye on those areas of the shadow banking sector that do maturity transformation and where they are dependent on short-term funding. And I think you're going to see just as you've seen some marginal players in the mortgage markets pulling out because their wholesale funding is not available, I think you're going to see that in other parts of shadow banking.
But something actually blowing up? We have also liquidity concerns in other parts of the market.
Well, blowing up, I suspect it's more a slow puncture, probably, that people will just be withdrawing from the market. But I think any time you get a relatively sharp rise in interest rates, which is what we're having at the moment, then where you have to look is those people who are leveraged, where the leverage was comfortable when interest rates were 1%, but where it's not comfortable when interest rates are 5%. And that is, I think, shadow banking is part of that. But that's where I'd be looking as if I were the overseer of financial stability at the moment.
So Howard, going back to what you're seeing at NatWest with many of your customers and mortgages, are you seeing any signs of distress?
Not very much. But then what's important to note, I think, and it's not been discussed so much, is the mortgage market is a very different shape today than it was the last time we had a sharp rise in interest rates, which goes back way before the financial crisis. Now, for us, 92% of our mortgages are on fixed rate, 8% are standard variable. For a standard variable mortgage holder, mortgage rate goes up 0.5 point. You see it at the end of every month. For the 92% who are fixed, they're fixed at various different lengths. On average, I think it's about 2 years and 9 months. So if you can say about a third of them roll off every year. Yeah. Those people will face a very sharp increase in their interest rates because they will move off a fixed rate that might be based on 1.5% to one that might be based on 5% at the moment. So the incidence of distress will be very uneven across the market. There'll be plenty of people who for the next 2 or 3 years say, crisis, what crisis? My mortgage payments have stayed the same because I fixed last year. But so I think it's going to be very, very unusual, and we will see some signs of individuals in distress because of these jumps in the mortgage rate, but the many parts of the market will remain very calm.
I mean, at what point do interest rates peak? Are we looking at 5-6%? Could they go higher? And so what's the biggest danger point for the economy? Is it 18 months from now, or is it a short time?
Well, interestingly, in the case of mortgages, what it seems that the turmoil has done is bring forward the rise in the long end of the curve. So we're in the unusual position where the short end, the bank base rate's still quite low, and yet the curve has steepened sharply, so that at 10 years, you're talking at nearly at 5% in the gilt market, and of course people will price off that. So what you've seen is a very sharp rise, and therefore now fixed rates are very significantly repriced. The question I don't think anyone can answer is, well, what happens as the Bank of England raises rates, which we expect? The yield curve looks like that at the moment. As the bank raises rates, does it go like that? Or does it go like that? As the short rate rises, but the term premium doesn't go up very much. Because
what do you think it'll do?
Well, I think it'll be a bit more like that.
Like flat,
I think it'll, because I think it's very steep at the moment.
But I think if you look at real rates, for the 10-year, they're now above 1%. A month ago, they were still minus 1%.
Yes. So undoubtedly, the long end of the curve has been repriced, and that's partly because of the turmoil in the gilt market. This also, however, will depend on how the government issues its own debt. We know they're going to issue a lot. Will they issue continuing at very long rates, or will they sort of take advantage of the fact that the curve is the way it is and issue more short gilts? I think personally, I would say that might be quite a smart move at the moment.
So if you're a mortgage holder today, and actually I do get that question quite a lot from social media or people that will WhatsApp, first-time buyers, do you have any practical advice of what you should be looking at? Maybe, people that don't look at finance.
First time looking at my regulator, whom I always think over my shoulder here, I'm not registered to give financial advice as an individual.
Fair.
But I mean, I think what people have got to weigh up very carefully now is affordability at a different level. I mean, we stress our mortgages obviously at rates that are higher than the current rates. So when you come to us and ask for a mortgage, we would say, well, okay, Francine, how does this look if rates are 5 or 6%? How would your finances look? And we don't lend to you unless it looks as if you can carry on paying at that rate. So most of our mortgage portfolio is stressed at these levels of interest rates. Now, people won't like it you'll have to spend a bit less on designer dresses when this happens. But,
God forbid.
you will, in our view, if we'd given you a mortgage, we would have given you on the
safe.
basis that you could afford it.
Yeah.
You'd have to adjust your spending a bit, but you could afford it. So we hope that, given that we've been pretty prudent, and most of the big banks, I think, would be the same, that this won't create too much consumer distress, but it will create some problems for people who've got their spending out of balance.
But some of the banks actually had to pull mortgages when we had this discrepancy in the markets. NatWest didn't. Is it because you're hedged and stress test at a higher level?
Yes, well, we do two things. One, we're quite deposit rich at the moment, and secondly, we did hedge, and we were able to stay in the market. We thought that was the right thing to do because, there were people who were in chains and, transactions that needed to take place, and it was better for them even at a higher rate to do that than to lose the transaction. So we felt we should stick with our customers in that way, and we had hedged in such a way that we still wrote that business at a roughly acceptable margin.
We're also preparing for blackouts, managed blackouts from the government possibly over the winter months. How does NatWest manage that?
Well, that's a bit difficult for us because we don't have, any real ability as a normal financial business to sort of hedge against blackouts. I mean, we would have some issues. We have backup generators for our core systems, etc. I hope, touch wood, that we are reasonably well prepared for that. But I don't think a bank can really insulate itself to that degree.
Sir Howard, thank you so much, as always. Sir Howard Davies, there, Chairman of NatWest Group, of course, talking about housing, mortgages, GDP, and the Bank of England. Now, coming up, more on our top story this hour. Governor Bailey says the emergency support will end on Friday. We'll talk to guilt expert next. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So the Bank of England has reiterated its plan to end its emergency bond buying program on Friday, despite a conflicting report it could be extended. Now, joining us now is Bloomberg's Van Ram from our Markets Live team. Van, you always make me smarter on gilts, on what the Bank of England should and shouldn't do. Bailey talking tough. Is a BOE really going to stand firm?
Morning, Francine. It looks like the BOE's communication is all over the place. They've been saying, at least they issued a press statement earlier this week saying that the bond purchases will end this week. And that's what Bailey reiterated yesterday, which the markets took notice of. Now, there is also the other Financial Times report saying that they are open to extending purchases. So it's not really clear what the BOE is trying to do here. But it looks like from Bailey's position last night that they may have had a rethink and they may not extend bond purchases going beyond this week. And the markets are extremely nervous about it because if you look at the 30-year yield, where the BOE has a real presence in terms of the gilt auctions, the yields are up considerably today. And if that keeps going, then there is going to be a bit more volatility.
But so what are we looking at, Van? Is this like a massive gamble or just a policy mistake?
It is a gamble and a policy mistake, if you ask me, because interest rates in the UK ought to have been a lot higher given where inflation is at this point. So, but we are not even in neutral territory yet, which is an inexplicable policy lapse, no matter how you look at it. I mean, every other major central bank in the world is racing towards neutral or trying to go higher than that. Even the ECB is showing alacrity in getting to the neutral rate, whereas the BOE has been dragging its feet in getting to neutral rate. And now the markets are pricing in a terminal rate of 5.75. And that's light years away from where the BOE's rate is at the moment. We are at 2.25. So the BOE has got plenty more to do in the cycle. And it's not clear that they're willing customers to raise rates because for some reason or the other, and it may be the mortgage markets that they are worried about, that they are not willing to raise rates in this current cycle. Francine?
Yeah. But so, Van, is this trying to keep pressure? And I'm trying to find some positive. Is it trying to keep pressure on the government? So we're going to have 2 weeks of volatility, but that things could look a lot better for the UK?
Absolutely. I think it does put the government on the back foot. When Quarteng took over as Chancellor, it looked like the Bank of England maybe made to account for its lapse in controlling inflation, but now the boot looks like it's on the other foot, with the Bank of England trying to tell the government, look, you need to clean your act up now. So it's an interesting change of positions for the Bank of England and and Downing Street. And definitely the pressure will be on the government if the Bank of England is intent on ending its backstop.
Okay, Van, thanks so much, as always, making us smarter, of course, on gilts and all things bonds from our Markets Live team. Now, Bloomberg Surveillance continues in the next hour. Matt Miller, Kaylee Lyons are in New York, Anna Edwards here in London. They'll look at the Bank of England, they'll look at gilts, and, of course, sterling. One story dominating them all, of course, is what's happening with UK. Watch out for volatility and liquidity. This is Bloomberg.
about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
There's terrible pressure on the global economy.
I think we are at the kind of toughest spot, you know, in the year.
What we are is we're in a period of economic slowdown or deterioration.
The economy is starting to go through the windshield. The financial system is starting to go through the windshield. This is not stepping on the brakes. This is slamming the brakes.
This is not just a U.S. issue. This is a global issue.
Market functioning problem in the U.S., we haven't really seen it, especially when we compare it to what's happening in the U.K.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Drama at the Bank of England. Investors get whiplash as the Bank of England is forced to reaffirm Bailey's warning that the central bank will end its bond buying program on Friday. NATO defense chiefs gather in Brussels to discuss weapons production and support for Ukraine. Meanwhile, Joe Biden says the U.S. has gamed out responses if Vladimir Putin uses a nuclear weapon. And as Biden tries to downplay the recession risk, Intel cuts back. The chipmaker is planning thousands of job cuts as a broader slowdown adds to its challenges. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. It is only 10 a.m. here in London, I was going to say. I know it's much earlier with you, Kaylee, but we have already, as I said in the headlines, got whiplash around all UK assets this morning.
Yeah, back and forth, back and forth. The BOE clearly trying to push back against the Financial Times story that suggested that that deadline is going to be extended beyond Friday. A lot of volatility in UK markets. And of course, we've seen a lot of volatility in other markets around the world as well. Just to recap what happened in Asia overnight, it was an interesting mixed session. The MSCI Asia Pacific Index as a whole down about 0.1% as you saw stocks just a little bit lower in Japan and Hong Kong, but really interesting action in China in the latter half of the day. Some real dip buying coming in, maybe some bargain hunting for those really beaten down Chinese stocks. So that saw the CSI 300 actually rallying about 1.5%. And the biggest contributor to that on an individual stock basis was CATL, which of course is the big battery company. It forecasting a big surge in profits, so those shares up about 5% as a result. Finally, in foreign exchange, I just want to bring our attention to the Japanese yen. We are back at 146.30 32 on dollar yen. That is around the levels where we saw intervention last time, the first intervention to stem weakness in the yen, going all the way back to 1998 that we saw several weeks ago. So it raises the question is if more intervention may be coming, Matt, something we should all keep an eye out for.
Excellent. Also, 2 weeks from today, I will be going to Tokyo, Kaylee, so I'm looking forward to
Good
that.
for you.
Exchange rate staying the same. Not a lot stays the same in these markets, frankly. I mean, yesterday in the cash trade on the S&P, we were down, then we were up, then we were down again dramatically, and now the S&P futures are back up again. So a lot of volatility, to say the least. We see the 10-year yield, very little changed, but up almost at 4% at 3.9268. And we did, of course, come up through 4% briefly, very briefly yesterday for only the second time this month. And you can see NYMEX crude is coming down, 89.28 a barrel right now. So, but very little change. It'll be interesting because to watch this because President Biden has suggested consequences to Saudi Arabia for joining in the OPEC Plus decision to cut 2 million barrels of production a day. He doesn't say what consequences. They're in the process. Apparently, they hadn't thought about this before. They probably have to have meetings and figure out what to do. No one's ever gamed anything like that out before. Bitcoin right now, well, it's up 0.7%, but still holding at 19,159. This has been the least volatile asset that we've been watching for so long, and I find that so fascinating. Will it continue to stick in this range? And then just so that we've all said it, Anna, I want to point out that the Bank of England did come out and refute the FT report that they will continue their bond buying program past Friday. They say it goes only until Friday. So let's just timestamp this in case they decide to extend it.
Right. Okay. So this is 10:03 UK time. What is it? 5:03, 5:04, just about New York time. We'll keep this story under review, but that's where we are right now. I'm going to say the same thing, and again, when we look at my my assets I've chosen today, we look like a bit of a mess across European stocks today. The futures picture actually suggested we'd go higher. That's when US futures were much stronger. Then we didn't. We retreated at the start of the European trading day, and we've clawed back some of those losses, and now some of these markets look more positive. But a little bit of a messy picture and a lot of volatility in these markets, as we've said. So that's equities. Let's get to the UK assets. And to just recap where we have been then, the pound fell on those comments that we heard from Andrew Bailey last night, where he said the scheme ends on Friday. Pension funds, you have 3 days to get your houses in order. Then the FT story dropped early hours this morning, and that's led to a rally in the pound. Then the pound sold off again as the Bank of England was forced to come out and reaffirm what Bailey had said last night. And then the pound gained for who knows what reason, because that's where we are right now. 110.40, up by 7 cents of 1%. At the 30-year gilt yield, also responding to this story, perhaps we're seeing selling almost across the curve, although the short end looks a little different, but selling of UK gilts today continues with pressure on them, of course, because of what Bailey has said, with that line in the sand now being drawn. 4.9% is where we have got to on the 30-year yield. And it was going over 5, of course, initially, that seemed to trigger the Bank of England to want to get involved in buying bonds. LVMH, the luxury goods company, 2.9%. Matt, you are looking forward to going to Tokyo with your strong dollars. Well, it seems a lot of Americans have been coming to Europe with those strong dollars and buying some handbags and other luxury goods whilst they're here. LVMH doing very nicely as a result. And Philips down by 6.5% for the healthcare business. This after they had to take a non-cash charge linked to writing down the goodwill on their sleep business, but also, interestingly, more of a reader cost for other businesses because of ongoing supply chain issues.
You know, all of the handbags that you can buy in Europe, we can buy here and everywhere else in the world at every major airport.
There we go. But I guess it's the exchange rate that helps.
Yeah, I just want to point that out. All right, let's get more on that BOE drama. Whatever it takes until Friday. A spokesperson from the central bank reiterated Governor Andrew Bailey's warning that the bond buying program will end on Friday. Bailey spoke at the IIF event in Washington yesterday.
We've announced that we will be out by the end of this week. We think the rebalancing must be done. And my message to the funds involved and all the firms involved in managing those funds, you've got 3 days left now. You've got to get this done. Because, again, part of the essence, I think, of a financial stability intervention is that it is clearly temporary.
Bloomberg's Danny Berger joins us now for more. So Bailey says they're not going to extend the program, Danny. Do markets buy it?
Well,
they're volatile. I don't know. It's really difficult to discern exactly how markets are interpreting this. Anna went over the timeline, and for a radio listening audience, I have a very simple chart in front of me. It's sterling over the past 2 days, and I mean, the chart's really wild. You see what Anna was describing. He says those comments, it falls. You get the FT story that the BOE has talked to privately with bankers, that they will extend it. Pound rallies, is still higher today. And then, of course, the UK bond market on the long end of the curve is still selling off. And that would suggest that the bond vigilantes are still out there challenging the Bank of England, who only about an hour ago came out and said, a spokesperson said that they are still going to have that Friday cutoff date. Matt, I would say they didn't outright deny the story. They said they wouldn't comment on the story and offered this as an aside, so do with that with you will. But look, at stake here, it's more than just a liquidity crisis. It is a crisis of credibility, and this is one of the main tools of the central banks. But I wouldn't go as far just to say that it's credibility of Andrew Bailey himself, of what he says, because to be frank, this is something all central banks are struggling with right now, that they have these two primary objectives. One is to control short-term rates, manipulate central bank policy through that, and then the other is being the lender of last resort. What happens when those two goals are in direct opposition to each other? Do you danger doing one of those goals over one of the other, and that one becomes endangered? So it's something everyone is struggling with, and honestly, it seems like we're just watching the BOE try to figure that out in real time, Kaylee.
All right, Bloomberg's Danny Berger. You're going to have quite a roller coaster ride tracking this one, I am sure. Thank you so much. Let's turn now to geopolitics. NATO defense ministers are gathering in Brussels as Ukraine calls for more military equipment following a series of deadly missile strikes across its territory by Russia. NATO Secretary General Jens Stoltenberg is speaking right now. He has said, among his other comments, that the ministers will be discussing Ukraine air defense. Also on the subject of nuclear weapons, he said a nuclear strike by Russia would have consequences for Russia, but they have not yet seen any changes in nuclear posture. Let's get more on this now with Maria Tadeo, who is following the meeting at NATO headquarters. Maria, nuclear aside, we have seen a dramatic escalation in the war in the past week. How will NATO allies respond?
Yeah, and we've seen the bombings in Ukraine on Monday. That is what the country says was a Black Monday. 84 missiles were launched by the Russian Federation across the Ukrainian territory. The NATO Secretary General, by the way, just now he was speaking to us reporters, saying that this is the week of the most severe escalation in the war since it started back in February. They're going to talk about how to better help Ukraine protect itself. They talk about air defense systems. Remember, it seems again that the nature of this war is changing from the ground to the skies. And they will also talk about how to protect critical infrastructure in NATO itself. And this is a big talking point today. We have seen the explosions in Nord Stream 1, Nord Stream 2. The Secretary General talked about sabotage. And then, of course, today the Polish said that they detected a leak in an oil pipeline that goes through Germany. So now this is of the utmost concern for NATO, how to deal with potentially what could be a hybrid war.
Didn't the Polish suggest that they didn't find any evidence of sabotage?
Well, the Polish have said they found a leak, but what NATO says is that they want to investigate everything and see the entire results of everything. And by the way, when I spoke to the Latvian defense minister, he said he would not be surprised if pipelines mysteriously, don't work anymore. They explode, or we have issues with interconnections with the telecom sector. A lot of this is something that they will seriously consider today. There has been a remarkable change in tone over the past week when I talked to my sources now, and a week ago, who say this is something they now have to treat seriously.
Yes, this is something that Europe is taking seriously, is very ready for, of course, the threat of sabotage. Maria, you're right to point that out. But the Polish government official has been saying there's no reason to think the leak is sabotage, but I'm sure those inquiries are continuing. So that's NATO. That's where you are, Maria. Let me ask you about the G7 and how it is planning to respond to the latest escalation we've seen this week.
Well, Anna, it was pretty much essentially a repeat of what NATO talked about in their own statement. So we talk about the collective West. Well, they share a lot of the talking points here, but also once again reiterating that the G7 stands by Ukraine. They also warn that anything that looks like a nuclear, potentially even operation against the country will be met in the most severe terms. But to me, the real takeaway from that statement was President Zelensky. This went under the radar, but yesterday he said, and he described Vladimir Putin not as a Russian president, but, quote, as a terrorist, and once again repeated that at this point, Ukraine does not see a room for diplomacy. If you ask me, that was slightly underreported, but it really is a takeaway from this. The Ukrainians do not see a space for the time being in which they can engage diplomatically with Russia.
All right, Maria, thanks so much for joining us. Maria, today they're live at the NATO headquarters. Meanwhile, the U.S. is speeding up shipment of 2 advanced air defense systems to Ukraine. As Maria was just saying, President Biden said in a CNN interview yesterday that the U.S. has gamed out responses if Vladimir Putin uses a nuclear weapon. That doesn't seem like it would end well. Pivoting now to the economy, Biden downplayed the risk of a recession in the U.S., saying it's possible, but any downturn would be, quote, very slight.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly. Well, look, think about what's happened. We have done more. We're in a better position than any other major country in the world.
Yet fears of an economic stumble persist, of course. Intel is said to be planning job cuts, possibly in the thousands, as it looks to lower costs and cope with weakening demand. Bloomberg understands the layoffs could be announced as early as this month. Bloomberg's Tom McKenzie joins us now with more. Tom.
Yeah, so in terms of the timeline, October the 27th, that's when they're releasing their third quarter results. And the expectation from our reporting is that those announcements around job cuts could come on that day or around that date. So that's one to watch for. The analysts expect that with those earnings, they're going to announce a revenue drop of about 15%. Multiple different pressures on Intel. You've been talking about a number of them in the context of the broader tech space, but I'll just run through some of the key hits to this company. They're seeing their margins squeezed, the competition with AMD. They haven't managed to claw back some of the market share that they've lost to that company. China is their biggest market. You've seen, of course, those restrictions put in place on Friday. That's a big hit to Intel as well going forward. And then crucially, that demand for PC processors, on which Intel depends so greatly as a key part of its sales, that has been hit as well, slowed down significantly. What you could be looking at then, according to our reporting, particularly the sales and marketing group, that is where the axe could fall the heaviest. You could be looking at a 20% cut to jobs. Something of a template in 2016, they cut 11,000 jobs. The stock is down 50% year to date. Bloomberg Intelligence says this could lead to cost savings of between 25 and 30 billion. We'll see if that does anything to the stock price going forward.
It's interesting that a lot of the job cut stories we cover from the US do seem to involve the tech industry, and this in the hardware side as well as others. But Tom, thanks very much for that. Bloomberg's Tom McKenzie joining us with the latest on the US economy and the jobs fallout so far. Coming up on the program, Ben Emmons joins us, Managing Director for Global Macro Strategy at Medley Global Advisors. How is he navigating the difficult waters of the UK asset classes right now? And an exclusive with Greenlight Capital President David Einhorn. More on what he thinks about the future of investing ahead.
Relating to value investing, I don't know that it ever comes back. You know, there have been serious changes to the market structure, and pretty much most of the value investors have been put out of business.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink. The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus tomorrow on Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards out of London. Now, we are looking at a situation with UK rates where they continue to rise even after the Bank of England tries to tamp them down, or at least tries to stop financial instability, because the rise that we saw after Kwasi Kwarteng's mini budget, which the IMF calls a textbook case of how not to budget your country, was very fast. And now we've seen a more gradual rise. Maybe that's better, but it hasn't stopped volatility in markets. Joining us now is Lynn Thomason, Bloomberg Markets Managing Editor. Lynn, yesterday, in fact, was a textbook case of volatility. Was this all caused by the Bank of England, by the gilt market?
Yeah, I think a lot of it absolutely is being caused by really the chaos that's happening in the gilt market, and the fact that people don't know what the BOE is really trying to do. Are they, on one hand, they're saying they want to remove the emergency backstop, and the other hand, it seems like maybe that's not the case.
Okay, Lynn, just as you're speaking, we're getting yet another comment from the Bank of England. A Bank of England spokesperson reiterating targeted gilt buying will end on October the 14th, saying the governor made the position clear in contact with banks. So this does seem to be a little bit of a pushback, once again, against what was reported elsewhere in other media overnight. I mean, is this a case of the lady protesting too much, which might spring to mind? But we've talked to so many guests who just keep saying if there is chaos in the markets, they will extend. But here they are once again saying that they really won't. Yeah, absolutely. I think the overall picture, it's very confusing. A lot of traders are scratching their head thinking, isn't the BOE supposed to be, the system of last resort for the market? And I think it really speaks to how unusual of a situation that we're in. I can't think of another time where you saw a central bank really setting out such a hard line like this.
How much worse could the U.S. CPI data tomorrow make things, Lynn?
Ooh, probably a lot worse, as we saw from just a few days ago when the jobs report came in and you saw markets selling off. I think we're really looking for any indication on is inflation under control or is it not? And I think, obviously the CPI report will be what everyone's watching. The Bank of England also saying then this morning facilities, including the TECRF, that's the Temporary Expanded Collateral Repo Facility, will continue after Friday. That was as planned to November the 10th. They hope that will take the pressure off the liability-driven investment funds that help the pensions industry. Lynn, thank you very much. Thanks for your time. Lynn Thomason joining us there, responding to some of these live comments coming through from the Bank of England right now. If you want more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky. The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink. The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus tomorrow on Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Polish authorities say they believe a leak in an oil pipeline bringing Russian oil to Europe is probably an accident. Poland's top official in charge of strategic energy infrastructure says he has no reason to assume it was an act of sabotage. Pipeline operator PERN says it expects to know the potential causes in a few hours. European authorities are on high alert for any signs of sabotage on energy infrastructure since the destruction of the Nord Stream gas pipelines last month. The UK economy shrank unexpectedly in August for the second time in 3 months, raising the possibility that the country is now in a recession. The Office for National Statistics says the sharp 0.3% drop in industrial production was the main cause of the decline. Many analysts anticipate the decline means the economy will be lucky to avoid a downturn in the third quarter. Lockdown fears in Shanghai. Schools and other venues are quietly shutting down as officials try to rein in a COVID flare-up that's hit the financial hub. Several schools dotted throughout the city have suspended in-person classes, according to parents and social media posts. COVID prevention offices say they, at least 5 districts, have closed entertainment venues, including cinemas, bars, and gyms. And the U.S. Justice Department is investigating whether Credit Suisse continued to help clients evade taxes years after it pledged to tackle the issue. The latest probe comes 8 years after the bank paid a $2.6 billion settlement in the U.S. Credit Suisse denies any improper conduct and says it is cooperating with authorities. But man, it is just one thing after another for Credit Suisse. And that is the story we continue to follow.
Yeah, we'll continue to watch it for sure. But the main concern, I think, is how they deal with the current liquidity issue and whether or not they have to raise capital.
Yeah, absolutely. October 27th, then, we focus in on that. Coming up, Ben Emons joins us, Managing Director for Global Macro Strategy at Medley Global Advisors. We'll get back to some of the UK tails wagging the global market dog shortly. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Drama at the Bank of England. Investors get whiplash as the BOE is forced to reaffirm Bailey's warning that the central bank will end its bond buying program on Friday. NATO defense chiefs gather in Brussels to discuss weapons production and support for Ukraine. Meanwhile, Joe Biden says the US has gamed out responses if Vladimir Putin uses a nuclear weapon. And as Biden tries to downplay the recession risk, Intel cuts back. The chipmaker is planning thousands of job cuts as a broader slowdown adds to its challenges. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons here in New York. The Bank of England certainly with plenty of challenges. The UK government with a few of those as well there, Matt. That's the European story, but broadly the global picture looking a little bit more risk on than it did just half an hour ago.
Yeah, the Bank of England seems to be trying to save the UK from the UK government. We'll see if they continue that experiment past Friday. Let's take a look at what's going on in U.S. assets. The S&P futures right now up 1 solid percent. Now, it should be pointed out that we were down yesterday at the beginning, and then we were up in the middle of the day, and then right at the end of the session, we came straight back down. So a lot of volatility, and we still have 4 hours to go until the opening bell. The 10-year yield at 391.86. Yesterday went up through 4%. I believe it did on September 28th as well. So we're kind of on 4% watch, but now coming the other way as investors buy those bonds. They're also buying crude, but only adding 49 cents a barrel right now to 89.87. I thought that it was very interesting that President Biden said there will be consequences for Saudi Arabia, that the relationship needs to change after OPEC Plus cut production by a headline 2 million barrels a day. So we'll see what those consequences are. Right now, they're apparently in process. Not clear how long it's going to take until we understand. Bitcoin, by the way, continues to remain in the range that we've seen for so long, really, Kaylee, since June. I mean, it's been up to 24 and down to 17, but just hovering around 20 for the most part right now at $19,172. What do you see in the pre-market movers?
Well, I want to begin with Intel, Matt, because this was a big story. Bloomberg reporting yesterday that it could be cutting thousands of jobs as it attempts to rein in costs as it contends with a slowdown broadly in the PC market. Interestingly, the market taking pretty kindly to that in pre-market trading this morning. Maybe investors like the idea of Intel pulling back on costs because it's up about 1.5%. But of course, it also is in tandem with a broader rebound in the chip space, which has had a very painful couple of days. NVIDIA, for example, down 12% with 4 down days in a row. It is rebounding, though, this morning to the tune of about 1.6% in early hours. And we're seeing broadly big tech stocks getting a lift, too, as we see yields moving lower, a bit more risk sentiment, as Anna was saying, coming through. So Tesla and Apple are each up a little more than 1%.
Kaylee, let's just focus in on UK assets for a moment. We've just got some new news lines, just to flash them across the bottom of the screen there as Kaylee was speaking. The Bank of England maintains its counter-cyclical capital buffer at 2%. The Bank of England is ready to vary that buffer rate, though, in either direction if needed. And this is a measure that they brought in post-financial crisis. It's a way of stabilizing the banking sector in a counter-cyclical, as the name would suggest, counter-cyclical way, so making sure that banks have enough in reserve for the tough times. So is this just is there any messaging behind this, or just a sort of statement of what they always are able to do, which is vary that buffer rate? More on that, no doubt, to come as we read through that statement in more detail. This is what we see, though, on European assets right now. The stock 600 then up by 0.4%. The 30-year yield, and it's interesting that these comments come from the Bank of England at a time when we're dealing with such volatility in UK assets. We've talked about the roller coaster in the pound. Here's the 30-year yield, 4.92%, so very close to the 5% mark. We are seeing at the long end of the curve that selling of bonds continuing and the yields going higher. But as Matt pointed out rightly earlier, that rise in yields has been at least slowed down by what the Bank of England has done in terms of its intervention at the long end. LVMH then, a lot of Americans in Europe armed with very strong dollars buying up luxury goods, and that stock up by 3.2% as a result. Philips down by 5.4%. They took a non-cash charge based on a write-down of the goodwill of their sleep business. Also, though, interestingly for other companies, talking about supply chain disruptions, Matt, that are still ongoing.
All right, we're going to talk more about this right now with Ben Emmons, Managing Director for Global Macro Strategy at Medley Global Advisors. He's in the office with us, in the studio up early. Ben, great to have you here. Thanks for joining us. Before we get to the world's largest economy suffering a fool in the shower, possibly, let's talk about what an IMF official yesterday described as the British economy is a car, and it's got two drivers, each with a steering wheel. One, of course, being Kwasi Kwarteng, and the other one being Andrew Bailey. What do you think about the BOE bailing out the British government, and how long will it last?
Yeah, Matt, it looks like it's a really close window, as we were talking about, right? So he's put the pension system on basically a time alert, saying you gotta get this done, which I think he really is saying, like, he probably have insight on how much hedging is in these LDI derivatives and how much selling needs to be happening. And then that's it, right? They close it off because the economy is falling in a recession, which ironically actually would need quantitative easing. But
this is, essentially.
Which this is indeed, because you're lowering long-term interest rates, you're adding liquidity to the system. But it is a situation of an inflation that's completely out of control. So they got to do that work. And I think this is why they're standing pat and want to say, look, you don't have much more time. We just cannot continue with quantitative easing.
Right, and we've heard a few lines this morning. Good to see you, Ben, from the Bank of England. I mentioned some of them around the counter-cyclical buffer. They're giving us the results of one of their meetings over at the BOE, saying the deadline has been made absolutely clear to banks. So once again, reiterating that the deadline stands on Friday, and they want LDI funds to be better prepared for future stresses. So they're certainly putting that line in the sand. What is the peril of putting that line in the sand, Ben? What is the risk attached with saying on Friday the Bank of England steps back?
So this morning, Anna, there was a story out in Wall Street Journal about that actually pension funds in the UK have been selling collateralized loan obligations to meet their margin requirements on those derivatives. And that's a segment of our markets that's illiquid, right? And that could continue. So there's one of that consequences of that it has a spillover effect to other markets, like collateral loan obligations that then spill into the equity markets and cause friction. The other one, of course, as we're closely watching, is what will the pound do? If it does lead to a crash of the pound, then you do get a confidence crisis. So it is really a knife-edge situation. I think to Matt's description of two people in a car, both at the steering wheel, both want to pull each other's steering wheel, I think is that analogy of like you're really heading for this cliff if you follow this action.
Well, and we can talk about the two people steering the car in terms of fiscal and monetary policy, but there is also what central banks are attempting to message and do and what the market response is. You can call them vigilantes, maybe what we've seen in the UK bond market over the last several weeks, and even here in the US, the Federal Reserve continually says, once we get up to terminal, we are staying there. If you're betting on cuts next year, it's too early, and the market still is sticking by the fact that it thinks the Fed is wrong. I mean, where is the credibility of these central banks right now?
It's still in deficit, Kaylee. It's not really getting the traction from the markets and saying, you really truly are ahead of this problem. You were too late, as everybody has concluded, and you have to ratchet up even more. You know, I liken it sort of what the Bank of Brazil has been doing, far more ahead of any other central bank. They keep going until they make absolutely certain that they get inflation under control. And that's what the central banks are signaling they're not, right? They want to ratchet up to a level and then stop. So the market's challenging that, say, you know, if you do that, you not get the situation under control, and you would have to reverse to cuts or getting this strange situation that we're seeing in the UK, which makes matters worse. So I think this is the tension that we're going to stay in until, you know, it flushes out.
Well, the concern is that something breaks, right? We've heard El Arian criticize the Fed again. We've heard Larry Summers say that maybe they'll be able to deal with it. But to get back to an analogy that maybe all of us have heard too much, but I still love so much, Milton Friedman's Fool in the Shower. When the water's too cold, you turn on the hot water all the way, not realizing that it takes a while for that heat to come out, and then you burn yourself. Is the Fed risking burning the American economy?
That's certainly a risk, because it's...
Or freezing, as it may be,
freezing,
right?
maybe too, yeah. You know, that is, of course, a risk, Matt, because, you know, that's been a history of tightening that had that negative effect on the economy. It spills over, and to Lil Brainerd's speech, she already is making this point of saying it's already coming through, right? It's starting to happen. So pushing it harder, obviously, is going to affect the economy. I think, though, that this idea of, like, adding hot water to when the water is still cold, you know, Milton Friedman said, do it with a dosing. I do it like in certain stages.
Not front-loading at 75 basis points a meeting.
Right, so, and that is what the market is also, of course, constantly trying to trade here. You are going to have at some point to very quickly shift to a slower pace of tightening because the slowdown is getting accelerated. So that's the other tension, I think, in the market, that is the pivot trade, right? That's hanging.
Well, and of course, the market is so focused on macro policy right now, and for good reason, but we're about to get a whole lot of micro. JP Morgan's going to kick off earnings season come Friday. What do you think that micro picture is going to tell us on an individual company level, and what ultimately will that mean for the equity market if earnings no longer are able to hang in there?
Yeah, and then you shift the attention really to the profit margins, because there's where I think that the pressure will be, where inflation is coming through, all the costs are coming through, and these margins start to shrink. That has not happened yet. All the data shows that we haven't rolled really over there. I think, and the analyst expectations haven't, for now, adjusted there either. So that's going to be the sticker shock, I think, coming out of these earnings. It's not the top line EPS, it's the margins.
Yeah, and here in Europe, that manifests as vulnerability around higher interest rates, banks and real estate, the worst performing sectors just today in these markets. Ben, thanks so much for joining us. Ben Emmons of Medley Global Advisors. Coming up on the programme, have we seen the death of value investing? Part of our exclusive interview with Greenlight Capital President David Einhorn. That's next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Now, hedge fund manager David Einhorn says he doesn't know if value investing will ever be in vogue again. He spoke with Bloomberg's Sonali Basak exclusively on the sidelines of the Robin Hood Investors Conference yesterday.
Relating to value investing, I don't know that it ever comes back. You know, there have been serious changes to the market structure, and pretty much most of the value investors have been put out of business. So if value investing is trying to do security analysis, think about what companies are worth, think about why they might be misvalued or misunderstood, and then do valuation analysis that tells you that that in fact is true, there's just very few of us left. Most market participants these days, they either cannot do value, they're just not trained or experienced in knowing how to do valuations, or their structure doesn't allow them to. Like if they're an index fund or a passive thing, the last thing you're doing is value, or their system is a quantitative system or a trading system or an algorithmic system, and or your style is to just buy things that have charts that go up and to the right. Right? And none of those participants are really doing value. So it used to be, you know, that on every conference call of every company, there were like dozens of analysts from all of these competing long only, hedge fund, long short people and stuff like that, trying to hear what companies were doing and saying and trying to figure it out. And those staffs have been gutted because the world has moved passive. And so there's just a lot less competition for what we do.
Well, what does that mean for how you operate as an investor? If you're saying that so much of the world has turned passive or quantitative, has that made your job fundamentally different as somebody who picks specific securities?
It absolutely does. It used to be we could buy something at a reasonably low multiple, whatever we thought that was, think that the company would do somewhat better, benefit from it being somewhat better, and realize that other investors would see what we saw 6 months later, a year later, and would re-rate the shares. So you could buy something 11 times earnings, and maybe they would earn 10% more, but you'd get another 3 points on the multiple, and you'd make 50% over 2 or 3 years. That isn't happening anymore because there's nobody to notice what actually happens at these companies. So we have to be, the other side of that is nobody knows what anything is worth. So there's an enormous number of companies that are dramatically misvalued in ways that we haven't seen before. So whereas before we might pay 8 times or 9 times or 12 times, which seem like low multiples, but now we can buy a lot of those same companies at 3 times earnings or 4 times earnings. And if they're buying back 10 or 15 or 20 or 40% of their stock in some cases, eventually we're going to have to get paid by the company as opposed to having other investors figure out what we thought we figured out before them.
That was David Einhorn speaking exclusively with Bloomberg's Sonali Basak, who was up early after a big day yesterday, joining us on set here in New York. Sonali, it wasn't just David Einhorn you got to speak with. You were at that Robin Hood Investors Conference yesterday. Also, there was the Greenwich Economic Forum. I mean, other than perhaps the death of, and that too, the death of value investing, what were some of your other takeaways from those conversations you had?
I think it's really interesting to see investors navigate the world after quantitative easing and what that looks like. The throwing away of value investing was really a comment about the structural changes in the market here. Why is that interesting? Because other value investors, like Cliff Asness, is saying that value is at its best, really premium that you're seeing here in history relative to what you're seeing even compared to the tech bubble. So, you know, you do have some differences here, and I think what the bottom line is here is that this is not your father's market. This is, you have to really change strategies here and start to pivot and start to kind of react to what the new market structure looks like.
It's interesting because the big take today is about just the absolute saturation in this market of long equity hedge funds, and they've been pretty much dead since although still in abundance, since the great financial crisis, right?
So let me give you some numbers here. Nishant Kumar really put this out very well in the Big Take today, and it's still the dominant strategy. But why does this matter? It's so close to being overtaken by multi-strat. When I was preparing for David Einhorn's interview yesterday, I talked to a lot of long-short managers who wanted me to really understand, is the long-short model dead? Here's the thing. If you look at the hedge fund index that's tracked by Bloomberg, long-only strategies are doing worse than long-short strategies, which shows you that there's a reason to short still, and frankly, a lot of people are still, David Einhorn is net short in a lot of ways also. So there is a role to shorting here, but it is true that all the multi-strats this year, whether you're thinking the D. Shaws of the world or Citadel, they're doing better than the traditional long-short manager.
Shanali, good morning. What stood out to me from what you were doing yesterday, all the stories you were covering and the interviews you were doing, is the number of people talking about distressed assets being an interesting asset class at the moment. That we had Barry Sternlicht talking about that, Apollo's Zelta talking about that, a real focus on distress.
I'm glad you brought that up too, because if we're sitting here talking about value, Anna, it's interesting. Whether you're a value investor in the stock market, the big debt investors that focus on value seem to find a lot more opportunity. When that comes, I think, is a huge debate. Jim Zelter, the co-president of Apollo, said he says that a little bit further away, maybe 6-12 months further along here. But you see Barry Sternlicht of Starwood Capital really seeing opportunities right now. And again, those structural changes we were talking about really come down to the banks, where they've stepped back and where guys like Barry can step in.
So for me, the story, the investing story of the year is something else that Nishant has been writing about, not the long-short hedge funds that perpetually disappoint, but the macro funds that are knocking it out of the park. I mean, when you think of Crispin O'Day or any of these guys that are betting against rates, they're making 200, 300% returns.
Yeah, so Hadar is another one, best year ever, a lot of focus on him. The other interesting thing about that is you had Ray Dalio speaking yesterday to David Weston, and he's telling you that currencies all over the world are trouble. And so when you're making money in macro, it's a very complicated equation here. You can get burned really quickly. I spoke to a couple big investors yesterday who were playing around in the UK, and none of them wanted to make a lot of conviction, given the whipsawing you're seeing with in the narratives with the BOE. So
or go public, right? Because it doesn't look very good if you're betting against the pound. George Soros didn't get a great reputation.
But we're not there yet, is also what I'm saying. At least a lot of the big investors have not put that type of conviction on their trades because they've gotten burned a lot this year too, and you see that in the numbers. The yen, I would also say, is the other area people are really worried about. And back to David Einhorn, one of the things he was really worried about, he said people are a little overly focused on monetary policy and they're not focused enough on fiscal. What he's most worried about as the systemic risk is the government balance sheets here in the United States as well as across the world.
Okay, Shanali, that is really interesting. Your comments all round really on the interviews you were doing yesterday, but also on what hedge funds and others are thinking about the UK. Very interesting story. Certainly feels from here like there's a lot of people playing around with UK assets, to use your phrase. Shanali Basak there in New York. Now, coming up on the program, Bloomberg Invest, in fact, coming up a little bit later on, Bloomberg Invest New York returns in person to bring together the most influential, dynamic and innovative figures in investing and markets. Today, they'll be hearing from Grayscale CEO Michael Sonnenschein and Pantera Capital CEO Dan Moorhead joins also, among many others. Look for those interviews throughout the day. This is Bloomberg.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leanie Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now a quick look at what is coming up for the rest of the day. NATO defense ministers are gathering in Brussels for a two-day meeting. We'll get U.S. PPI data at 8:30 a.m. New York time, and Fed minutes are due at 2 p.m. Eastern. But of course, it's not just about the Fed today, Anna. All of our attention is on the BOE.
Yeah, absolutely. A lot of focus on the BOE and continued focus on the rising yield environment that we see, certainly the 30-year at 4.96% right now. Now, previous bouts of trading turmoil in the UK have ended in balance sheet expansion by the Bank of England. Our markets editor, Valerie Teitel, is back with us to talk about why the BOE putting a line in the sand on ending purchases this time round is making markets nervous. And we were expressing it this way earlier, saying that, you know, this was a kind of, they'll do whatever it takes at the moment, or they'll do a lot at the moment, but don't ask after Friday.
Yes, that's right, Anna. Now, I wanted to look back at previous points where UK assets expressed some sort of EM-like trading, which it's come under focus a lot recently, the fact that we've had the currency weakening alongside yields rising. And this analysis was done by Brett Donnelly at Spectrum Markets, and he found that there were 2 times in the last 20 years where UK assets had this kind of move. One was in September 2009. That was during the global financial crisis when the Bank of England announced their the bank bailout, excuse me. And another time was in 2016 around the political turmoil of the Brexit vote. Now, for our radio audience listeners, I have a chart here. Hit GTV Go. It's the timeline of the Bank of England's balance sheet and how it's expanded. Now, I want to focus on these 2 points in the recent history where we saw this EM movement. And both of those times, it was analogous with balance sheet expansion in 2008, in 2009, and in 2016, 2017. Now, the whole world is really watching with bated breath if the Bank of England is really able to take this situation under control without a massive balance sheet expansion this time.
Okay, really interesting chart, Valerie. Thank you for bringing it to us. Yeah, GTV Go, the function to use on your Bloomberg terminal if you want to see that in detail. Safe to say, the market has in the past got used to relying on that backstop from the Bank of England. That is it for early edition. Surveillance with Tom, John, and Lisa is still ahead. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The question is, like, does the Fed blink? I don't think they will.
How do you explain to markets and the public that you still have resolve in fighting inflation if you're slowing down rate hikes?
Instead, inflation got out of control, and now they need to really get it under control, which is going to be a process.
The Fed have got a domestically focused mandate.
Market functioning problem in the U.S., we haven't really seen it, especially when we compare it to what's happening in the U.K.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Futures just about positive this morning, up 0.8%. Bramo, equities at new lows yesterday. Two-year yields at new highs.
And people blaming the United Kingdom once more, basically saying that the Bank of England might be a part of what's behind this. Nonetheless, this gloom, the pervasive gloom that you're hearing from pretty much everyone, even President Biden coming out and saying that the chances of a recession, a small recession, look reasonable. And at what point does this really feed into that gloom that has already taken hold of
the Bank of England? Governor Bailey coming out yesterday and saying you've got 3 days. The Financial Times reporting that maybe the Bank of England had told banks that they've got more than 3 days, and then the Bank of England comes out again and says, no, you've got 3 days. This is a mess.
It's a mess, and it's a credibility issue. And at this point, and I point to Jordan Rochester and what he said in a note this morning, if the Bank of England does reverse, it's not a positive for the pound. At this point, the lack of credibility, the lack of consistent messaging, and the lack of sort of any cohesive plan of what they're trying to do. Yes, they don't want to necessarily cap yields, but they don't want financial instability. Define the two. It's a mess.
Let's whip through this price action for you. It's not that messy this morning. Futures are up by around about 0.8% on the S&P. Yields are going nowhere at 394.32 on a 10-year. Euro dollar unchanged at 97.07. Yesterday, Mohamed Al-Arian turned around on this program and said that the IMF meetings this week will have a 2008-like feel to it. TK, you're down at those IMF meetings this week. Walk us through what's coming up.
John, this is an extraordinary moment here for the World Bank, the IIF as well, and we'll talk here to their people today. But far more, it's about the International Monetary Fund. John, as you mentioned, it is without question the most important meetings, the most tense meetings since 2008. What I would note, John, is the data shows up right on time with yen going out to 146, many strategists modeling a weak yen out to 150. And critically, John, as you mentioned, the United Kingdom, a complete total mess. There was one point yesterday, John, where I looked at 3 British newspapers and they had 3 different headlines about what Governor Bailey's going to do.
Tom, I know you've got some great guests coming up later, and we're looking forward to hearing from you with them. Lisa, just an absolute mess for so many people in this Bank of England. The worry for me, I think the governor at the moment and this Bank of England is overly concerned about contributing to perceived fiscal dominance. The idea that they'll just focus on accommodating the fiscal effort of this government at the expense of tackling inflation. That's problematic.
It's also problematic to think that the pension funds can remedy their issues, their structural issues that have been built over a decade in a matter of days or a couple of weeks. And this really creates the real rock and a hard place that the Bank of England is between. If they're trying to talk financial stability on one hand, and they don't want to necessarily cap yields, to your point, they don't want to be basically facilitators for a budget. How do they do that at a time when they are really on the brink of financial stability concerns that are pretty significant?
Joining us now is Ben Laidler, the global market strategist at eToro. Ben, let's start with the UK. Can you help us get a better understanding of what happens if the gilt market operation of this Bank of England ends in 2 days' time?
We've basically flipped from an energy crisis, which I think the government has sort of successfully neutralized, but in the process, they've stoked this bond market firestorm, which was exacerbated by this sort of self-inflicted misstep from the governor of the Bank of England yesterday. And this is morphing into a broader economic confidence crisis. If you're a consumer in the UK today, picking up these newspapers, looking at your mortgage rate, which is probably going to reset at some point in the next 2 years, and looking at all the doom and gloom that's coming, what are you going to do? You're going to do as little as possible. You're going to save as much as possible. I mean, we had economic numbers this morning, which basically show that the economy is sort of barreling towards recession. And all this doom and gloom, this sort of doom loop out of financial markets with bond yields now back at where they were on that inglorious September 28th day. It's just hastening or broadening this economic precipice that we're on the edge of right now.
Well, Ben, talking about the economic precipice, how does this change your view of the fragility or perhaps how close we are to the culmination of some of these pressures, at least from a market perspective?
So in the UK, I think support has to be extended. And I think this sort of talking out of both sides of your mouth needs to be sort of resolved as soon as possible. Otherwise, I think the markets are just going to continue to push these bond yields higher, and that's going to spread contagion, certainly in the UK. But I think the real significance here is, the world's watching. This could easily be Italy, or US bond yield, 10-year bond yields now, the cusp is sort of 4%. I mean, this is not just a UK issue. This bond rout is going global, and for markets to sort of find their feet, I think you need a sort of fire break for how high bond yields are going to go. I think you need, hopefully, some continued signs that inflation is easing. All the inflation lead indicators are easing, but the headline inflation numbers are not. And I think that is the key. And then I think the third one would just be, hopefully, another less bad earnings season, which we're on the sort of cusp of right now, to maybe just remind us that however bad things are, we're not at, they're not maybe quite terrible yet.
They're not quite terrible yet. Does that mean that you expect them to get more terrible? Does that mean that you're sort of hunkering down in a significant portion of cash? Or are you seeing that this is sort of creating the end of a painful cycle that will create some buying opportunities?
So I do think the glass is sort of half full. I may sound crazy to sort of say that, but I do think the Fed will start decelerating here. I do think all the inflation lead indicators are falling, even though the reported numbers, are not. I do think that we're reaching the point where there's a limit to how high bond yields can go, with inflation lead indicators falling, with recession risks rising, and I am confident that companies can do what they did in the second quarter and just show us maybe that things aren't as bad as maybe the market's sort of pricing right now. And I think that I think allows us to begin to dig ourselves out of this hole that we're in right now.
Ben, you're talking about the earnings of the last quarter. This is what Bank of America had to say on that. Consensus feedback from clients. The third quarter might hold up, but who cares? Guidance is going to be absolutely terrible. Ben, what would you say back to that?
I don't disagree. I mean, I think this is more about the guidance than the reported earnings. So the reported earnings are going to hang on in there. But I think so far, the forward guidance, you've had more people raising guidance than cutting guidance. And so, again, we haven't even started yet, right? But upgrades minus downgrades, or the number of companies that are improving guidance rather than cutting guidance, has actually been a little bit better than you might have seen historically. So again, we'll see. I agree. It's all about the future. The future, is looking, is clearly darkening. But large cap companies have shown that they've been fairly nimble, fairly resilient, and I think I think a large number of them will continue to do that.
What do you make of that, Bramo? Never mind the earnings. Let's talk about the guidance. The guidance for next year. Have you seen how much the forecasts have come down from the IMF? They've come from close to 4 for global growth in 23, close to 3, and now heading down towards 2, very slowly for 23. And for advanced economies, the picture is even worse. We're talking a 1 handle, potentially, for GDP growth in 2023.
How much visibility do you think that these companies are going to have when it comes to guidance, which makes a really issue of how helpful can this actually be? We're already getting guidance. Are we missing it? I think that's the big takeaway, especially with Intel yesterday announcing thousands of job cuts, their first big cut to their workforce going back to 2016. Aren't we already getting some signs that we're seeing real weakness, John, in terms of the actions of certain corporate players here?
Laurie Cavacina of RBC came out with new forecasts. They cut their 22 forecast down to 3,800 from 4,200. They issue a new preliminary target of 4,100 for 23. She acknowledges in the note that it's still pretty early to try and make a big call with any conviction whatsoever about next year, but said this: Ben, the forecast is driven by the idea that 12-month rebounds of the stock market off of extreme lows in sentiment are powerful. I sense that probably resonates with you, Ben.
So sentiment is already completely capitulated. Valuations have come down a lot. They're below average. They're already looking for weak earnings. Earnings are going to keep drifting lower. I just don't think they're going to. I don't think they're going to capitulate. And I think the Fed will decelerate the pace of rate hikes. That's not a pivot, but I think we're not going to keep doing 75 basis points a meeting. We're going to go from 75 to 50 to 25, and we're going to pause at some point in the first quarter next year. That is a big catalyst. I think you put all that together, I think the glass is sort of half full. And just on the earnings, this is not all about earnings. We know that earnings are going to be dreadful. It's just a question of sort of how dreadful. I think from here, the story flips a little bit to become a little bit more about valuations. Bond yields peak, valuations are below long-term averages. I think we get some valuation relief, and it's valuations that have crushed the market this year. So yes, weaker earnings, maybe not capitulated earnings, but I do expect some valuation relief coming up.
Hey, Ben, thank you. Ben Lader there of eToro. That's the constructive way of looking at this market, I guess, Lisa, going into next year.
Okay.
That was it right there.
Do you think that a deceleration of rate hikes is a catalytic moment for gains in risk assets? This is actually one of the key questions right now. Ben was basically making that argument. Other people would say, well, why will they be decelerating? Will it be because there's some sort of virtuous cycle of slowing inflation, or is this going to be something more substantial, like a real downturn?
Well, I've said this a million times. If there is a positive supply side story to speak about that brings down inflation, that allows this Fed to back away, you can make the argument that's bullish. If the Fed's pausing and we have a recession and an economy rolling over all around us, then I think you're hard pushed to say that's bullish.
And right now, when you look out at the global economy, you can see new shutdowns in Shanghai ahead of the Party Congress. You can see factories idling for some of the time, certainly in Germany, as they try to save energy. Where is the supply side response going to come from?
We'll talk about the policy response in just a moment with Anne-Marie Hordern down in D.C. Coming up at 7:15, Anastasia Amoroso, the Chief Investment Strategist at iCapital. That'll be in the next hour. Looking forward to that. Live from New York. With Lisa Abramowitz, I'm Jonathan Ferro, Tom Keene in Washington, D.C. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China is doubling down on a defense of its COVID-0 policy, a strategy that's become a hallmark of Xi Jinping's rule. For the third day this week, the influential People's Daily newspaper, regarded as the mouthpiece of the party, mounted strong support of the country's zero-tolerance approach to the virus. Now, this comes ahead of a key Communist Party meeting, which starts on October 16th. Thailand will tighten its gun control in the wake of a mass shooting that left about 24 preschoolers dead. The Prime Minister says the government will revoke gun licenses if holders are found to be facing mental health issues. The crackdown comes after a former policeman opened fire last week at a daycare center in northeast Thailand, killing 36 people, including 24 children. Intel is said to be planning job cuts, possibly in the thousands, as it looks to lower costs to cope with weakening demand for personal computers. Bloomberg understands the layoffs could be announced as early as this month, around the same time as the company's third quarter earnings. LVMH sales have jumped despite fears of a global recession, with the world's biggest luxury group benefiting from wealthy American tourists shopping in Europe. The owner of Louis Vuitton and Christian Dior reported third quarter sales of fashion and leather goods up 22% on an organic basis. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. The market Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Strong enough to stay. We will never.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly. Well, look, think about what's happened. We have done more. We're in a better position than any other major country in the world.
The President of the United States on CNN yesterday evening, live from New York City this morning. Good morning. A rough ride in this equity market. The S&P 500 down for the previous 5 days. On the S&P this morning, futures bouncing back by 0.8%. Yields on the US 10-year unchanged at 394.93. In the gilt market, anything but unchanged. The 2 years down 8 basis points. The 10 years up 9. The 30-year is up 25 basis points right now and back through 5%. Closing high of the year on the 30-year gilt was 4.99 at the end of September. Intraday, we were higher than that, but back to 5 handles on a 30-year gilt. Lisa, the Bank of England operation, we've been told by the governor, by the Bank of England repeatedly, it will end in a couple of days' time. At the end of this week, the pressure's building maybe to extend.
Although, as Jordan Rochester said of Nomura, if they did extend, what does that mean for their credibility? What does that mean in terms of the pound? Not probably a good story either way for them. What this does suggest, though, is that the market dysfunction has not been remedied, that a lot of these pensions have not dealt with some of the liabilities, some of their imbalances, and it's going to be a problem for the Bank of England and possibly the Truss administration.
Up 25 basis points, a 5 handle again on a UK 30-year yield. We'll keep you up to speed on those moves. Joining us around the table, I'm pleased to say, is Bloomberg's Anne-Marie here in New York City, alongside Maria Tadeo in Brussels. AMH, I want to start with you and talk about the comments from the President of the United States yesterday. A month away from midterms, within a month now, and the pressure's starting to build again.
Yeah, it certainly is. I mean, the clip we just heard there was the president talking about the fact that, no, there's not going to be a recession. But as you say, a month away from the midterms, how can the president of the United States sit down in an interview and say to people, yes, prepare for a recession? That's not good signaling. But he did say potentially maybe there would be. I think he was trying to hint at potentially, maybe, hopefully, a soft landing. But it is ramping up for him right now, right? They have 4 weeks. And their issue right now, of course, is they have this spat with the Kingdom of Saudi Arabia, is how are they going to put a lid on gasoline prices? Because this still maintains the biggest issue going into the election. It's inflation.
Beyond the election, it goes into next year. I think the issue I have with policy right now is it's being calibrated to tackle a near-term calendar. So basically the short term. So you've got the policymakers in Europe focused on this winter and not thinking about what next looks like and the one after that. And you've got the administration thinking about the midterms and not thinking about what the oil market looks like in 2023.
Well, welcome to Washington, D.C., Jonathan.
It's a huge problem.
The entire calendar is based on politics. Not only is it a huge problem in Europe, more so than the United States, but also what you see what European leaders are doing is that at the very minimum, they are trying to prepare their populations. They are shutting down the lights at the Eiffel Tower. You have the French Finance Minister Bruno Le Maire saying, I'm going to be wearing turtlenecks every day this winter to make sure I could start saving on heat. And then the next day, Macron shows up to a press event in a turtleneck. You have not heard, though, that kind of rhetoric from this administration. Maybe preparing the American people. We are going to continue to support Ukraine, which might mean higher gasoline prices, and that is going to be the cost. Do the American people want that or not? That's a big question.
So, Maria, I toss this over to you because Anne-Marie is saying that over in Europe, there is a much more realistic addressing of the need to reduce some of the energy consumption. Do you think that that's true as the discussions of price caps go into effect in some sort of European continental basis at a time when there really isn't a plan to curb demand? I would say, and to be fair to European leaders, they really do feel that this is the winter of the breakup, of the rupture with Russia. This will be the biggest test, because if we want to continue sanctions into next year, you have to be able to weather the storm. So they are aware that storage season for next year will be even more complicated than this year. But what they say is, I have a near-term future or a near-term problem, and I have to deal with that, especially from the public reaction. If we want to continue this pressure, we need to make sure that we get ahead in this winter. Now, the other thing when it comes to the price cap, there is an active debate. They need something on paper. Remember, the Commission has been given a deadline to come up with a proposal by next week. So this time next week, October 20th and October 21st. But to add on to the headache, and this goes back to NATO, where I'm in today, there's a real concern, and you can really feel it behind the scenes, about what happens if a lot of the key infrastructure suddenly becomes damaged, or there are pipelines that mysteriously go down, or perhaps there are explosions, or to some extent traumatized, they say, by this Nord Stream 1 and Nord Stream 2. They want to figure out what happened there. So there is a real conversation about not just how we secure the supplies, but also how we keep this critical infrastructure safe and working throughout the winter. Maria, the subtext here is Vladimir Putin and what happens with Russia and their war against Ukraine. President Biden, in his interview last night, also called Vladimir Putin a rational actor who just miscalculated with this war. Is that basically the party line in Europe as well? Well, I think it's very difficult to second-guess Vladimir Putin, and everyone who's tried to second-guess Vladimir Putin has gotten it essentially wrong. What is right to mention and stress and highlight from the United States is that their intel was spot on, and the Europeans now recognize that their diagnosis was, in many ways, the correct one, and perhaps they were soft, thinking, how can he do this? There is no incentives to break up commercial relations, diplomatic relations to such an extent. The response from Ukraine, they probably thought, would not be as forceful as it is. But I think at this point, what they repeat, and again, it goes back very much to that message from the U.S. president too, is that they're in it for the long haul. They will continue to stand by Ukraine. And today, by the way, the Secretary General said what this country needs, and it needs quickly now, is air defense systems. We're seeing that the tactics are changing from hitting on the ground to going back to the air and pounding Ukraine from the air. So that is going to be the key takeaway from this meeting, how to provide air defense systems to this country.
Maria, thank you. Maria Tadeo there over in Brussels. And Maria, I just want to sit on the energy story. Too often, I think this is framed as a one-off shock, one war, one winter. And I think for many people in the energy market, it's a permanent shift away from Russian barrels, away from Russian gas. And when you calibrate a policy response to something, you have to understand, is it a one-off shock, one winter, one war, or is it a permanent shift? And if it's a permanent shift, you'd have to imagine the policy response is going to look a little bit different to the one we're getting.
100%. I think in the beginning, February, March, they thought it was going to be one winter, right? Maybe there's a peace agreement. Nord Stream 1, maybe even Nord Stream 2 at some point would come flowing, and we'd still have that cheap Russian gas. What you see in Europe now is an entire recalibration. You had Greta Thunberg in an interview with German TV telling the German government, you might as well keep nuclear still on if they're running, because it's better than coal. Germany is spending billions to build LNG terminals because they now need to import more liquefied natural gas. It is a complete recalibration for Europe.
Do you think that's the problem when teenagers start to shape policy? That this is where we end up? Seriously, the pandering on the left to big issues that can't be resolved overnight.
They can't be resolved. These issues cannot be resolved overnight. And winter 2023, winter 2024 is going to be incredibly challenging for Europe. The United States we are a net exporter of product.
Different situation in the US.
Completely different situation.
Totally.
And actually, when you look at gasoline prices, even though in Nevada, they're say $5 a gallon, in California, Ben Emmons was just telling me they're $6, the Europeans will laugh at us. That is their norm.
Anne-Marie Hildern here in New York City with us in the next hour as well, alongside Lisa Brambitz. I'm Jonathan Ferro, looking at a 30-year gilt yield up by 23 basis points, back to a 5 handle in the UK, as the Bank of England says that gilt market operation will end this Friday. Live from New York, this is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus tomorrow on Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Live from New York City this morning, good morning to you. A few hours away from the opening bell with equity futures still positive, just off session highs. We're positive 0.6% on the S&P, on the Nasdaq 100, up 0.8% after a 5-day losing streak on the S&P 500. Yesterday, new lows for the year on the S&P. Also yesterday, new highs for the year on a 2-year yield. Your bond market, 2s, 10s and 30s, shaping up as follows. The 2-year in America, yields coming in a couple of basis points, then up, then down. We're up about a basis point on a 10-year at 396.16, on a 30-year 394.15. Looking at the gilt market, all over the place as well. Your gilt market, the 30-year yield, up 24 basis points and back to a 5 handle. Mohammed Al-Arian and I, Lisa, discussed this at length yesterday. The policy trilemma of 2022. You've got the government trying to support growth, the Bank of England trying to bring down inflation, and financial stability getting stuck somewhere in between. How do you do all three simultaneously?
You fail. That seems to be the takeaway
and they're
from
fading
this.
right now.
But exactly. I mean, because it is a paradox. It is an unachievable goal to do everything at once and push all these different levers in a perfect way. At the same time that financing costs are going up so that there cannot be the same sort of fiscal sort of response on the other side. And this really, yes, it's a trilemma. It doesn't seem like there's a happy ending for it. And that's certainly what the signal is from the United Kingdom.
Well, these are the trade-offs we need to talk about. Could you have a permanent facility that looks at sitting at the long end of the gilt curve and still raise interest rates, do something at the front end at the same time?
They couldn't communicate that this is for financial stability. That would be
That's
about
the problem,
capping
isn't
yields.
it?
Because at this point, they're making the excuse that this is entirely for financial stability. It no longer is if suddenly they're just sitting there and they're trying to cap yields. But if they don't, then it cannot be really arranged so quickly that pensions will be able to get their books in order ahead of whatever is going to happen and leaving yields to get unmoored at whatever pace they're going to get.
I believe QT is still slated in for the end of this month. It's kind of crazy, isn't it? The calendar in the UK right now, October 14th, gilt market operation ends. End of the month, Halloween, we get the fiscal announcement alongside the forecasts for whatever they're worth. And then we get QT that's set to start a few days before the Bank of England's next decision.
It seems pretty impossible. I also just want to raise this issue of credibility because there were 2 emergency interventions within 24 hours from the Bank of England in this particular market, in the gilt market. And then there was, you've got 3 days, and then we're done. What message are they trying to say? What are the back workings of some of these discussions with some of these pension fund managers in order to say, we're getting fed up, guys, get it together, sell what you got to sell, even if it's at a discount, take a loss.
I'm happy to go after central bankers anytime, but just on the Governor Bailey quote from yesterday, you've got 3 days. Did people not realize it finished in 3 days? Like, what was the news in that? Were they thinking he would back away at the IMF meetings down in DC, that he wouldn't say it's going to end on October 14th? I was watching some of the coverage of this yesterday, and there were some people responding as if they didn't realize that actually the operation ended in 3 days.
I don't think it was an issue of ignorance. It sounds like it's an issue of a lot of companies hoping that there would be some sort of extension, hoping that there would be some sort of central bank put, so they wouldn't have to sell at such a massive discount. What you're getting right now is funds that are freezing. You're getting massive withdrawals from property funds. There is a desire to wait this out, hope that this is a temporary dislocation. How much is this? There is a lack of desire to have forced sales at a time of incredible turmoil.
Cliff Edge on Friday. I think a lot of people believe we've got one now. Your 30-year gilt, your yield is up around about 20 basis points at 498, very briefly breaking 5%. Joining us now is Andrew Sliman, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, you think we can get a rally into year-end? Give me the reasons why.
Well, I think we'll have a rally in the year-end, but I think the market right now is having a very hard time being competitive with the 2-year. I think you got to get the 2-year coming down before you can get a rally. I think that might happen into year-end. I'm not sure that today and tomorrow inflation prints will be particularly good, but I think they'll start to improve. Q3 earnings, I think, there's so much consensus now they're going to be bad. And they probably won't be good, but the consensus is so bad, it does remind me of Q2. And I think the market will start to anticipate that the Fed's positioning in 2023 is going to become increasingly untenable. Most everyone wants commodity inflation coming down, but it's going to be more difficult to, wring out wage inflation. I think that's less, applicable. There's a less of an appetite for that. And I think the market will anticipate. So I wouldn't be surprised you get your normal end of the year, midterm year rally. The question is, where do we go from it until then? And, as I said, I think with the 2-year at 4.3%, bonds just are a very attractive alternative stock. At this point, you need to see that yield come down first.
Andrew, for a long time, people have been conditioned, rewarded just to hug the benchmark, the market cap weighted S&P 500. That needs to change clearly this year. Andrew, does it need to change next year too?
Well, yeah, this is a big opportunity for someone like myself who's trying to drive alpha through active management. The top 10 stocks in the S&P are outrageously expensive compared to the other 490. And when I think about, okay, are we in a recession, not a recession? I don't think the top 10 stocks reflect a recession, but there are a whole host of stocks of the other 490 that are down 40, 50, 60%. That's a recession. Number two is, if in fact earnings do begin to miss, I'd much rather own stocks that are already down a lot, that PEs are very compressed, than huddle in a group of stocks that are still expensive. Because I think if the Fed were to, soften their stance, you could see the reverse of what happened this year, which is some PE expansion in very low PE stocks, even if earnings don't turn out to be so good. What I don't want to own is stocks that still have high PEs whose earnings have come through, and that seems to be in the very large cap stocks that are heavily weighted in the S&P. So I'm not particularly bullish on the S&P cap weighted as I look out the next 12 months.
So in other words, no big tech, but perhaps some of the home builders and some of the similar types of industries. You note that you like Home Depot, you like Lennar, you like some of these names that are tied to some of the pain that we've been seeing in the housing market. How much of that, Andrew, is hinged on this belief that there will be some sort of trigger, the sort of Ben Laidler comment of some deceleration in the pace of rate hikes, providing some relief, some optimism?
It's possible. What I can tell you is, if you look at these stocks the last 45 days, they've outperformed on a relative basis the stock market, even though, rates have continued to push higher. And the reason why that's important is these stocks started to underperform the market before mortgage rates started to lift. So they seem to do a good job of predicting where we're going in the future. And it goes back to this concept of what worries me in this market, this juncture, and I hear over and over, is people are, buying and huddled in defensives. And once you get to a bottom, the worst thing to own is the defensive because they will lag. And I'm not saying we're at a bottom, but you need to start to accumulate stocks that you think could have quite a move if the market were to recover. And I think some of these early cycle stocks are starting to show good relative performance, and I find that intriguing.
Andrew, right now, people are not worried about necessarily finding a bottom in specific stocks. I'm sure that they are on a sort of weekly basis. Right now, they're wondering about financial dysfunction on a pretty massive level, and you're starting to see signs of potential contagion from the UK market. Certainly, yesterday we saw that in the US market with stocks taking a leg lower, yields in the US taking a leg higher. Do you think that there is going to be some sort of inflection point, some sort of reckoning between financial stability and prioritizing that above perhaps tackling inflation at the speed that central banks have been trying to do so?
Great question. I'm just not sure we know the answer to that, Lisa. It's a very tough question to know. I note that some of the traditional things like high yield have not, relative to investment grade, have not screamed fear on a relative basis. But I'm an equity manager. What I'm more confident of is that pushing inflation down below a certain level by lowering wage inflation, pushing unemployment up, is going to become increasingly difficult for the Fed to stick to that policies, especially when you're having all these problems in other parts of the world. So the pressure is going to mount on the Fed. And I'm not saying, I don't like the term pivot, but I think there could be some moderation. And the question is, will the stock market anticipate that? Don't think it's now. It's too early. I just think it's coming next year. I'm more confident of that than the contagion issue that you articulate. But look, all central banks are trying to reverse a decade of QE, and it's proving to be very, very difficult.
Andrew Sliman, thank you, sir, of Morgan Stanley. It's proving to be incredibly difficult. This was the criticism that Al Arian had on this program yesterday, that it didn't have to be this way, that the Federal Reserve has had to slam on the brakes because it is so late. And Vice Chair Brainerd went through a long list of issues in the market right now. My word is issues, it wasn't hers. She was just reflecting on how much tightening we've seen already. Rates are up 300 basis points in 6 months. Mortgage rates in this country have more than doubled year to date. The dollar, their trade-weighted dollar, is up something like 10, 11 percentage points this year. That's a lot of tightening in this market.
I'm glad that you and Mohammed talked about the Lael Brainerd speech. I'm not sure it got enough attention. It was a little bit of a shift in tone relative to some of the other Fed officials in terms of emphasizing these particular issues, the push-pull, the balance of risks, including over-tightening and not allowing the lag effects to really take place. And that, I think, may be a shift in tone that we're going to be looking for over the next couple of months, certainly if there's any relief whatsoever.
But it should be an anticipated shift in tone. These guys want to pause at some point. That's what Charles Evans was talking about earlier this week as well. I just don't know if pausing as the economy is rolling over is as bullish as the equity market bulls would make it out to be.
I'm sympathetic to your view. I'm not going to push back on that one, and I think that you could hear that in my comment to Ben Laidler. There is an issue of if you start to see the earnings really prove the point, well, not exactly a rosy scenario.
The yields are up 21 basis points in the UK, 4.98, just short of 5%. We went through that level a little bit earlier this hour. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Polish authorities say they believe a leak in a pipeline bringing Russian oil to Europe is probably an accident. Poland's top official in charge of strategic energy infrastructure says he has no reason to assume it was an act of sabotage. Pipeline operator Pern says it expects to know the potential causes in just a few hours. European authorities are on high alert for any signs of sabotage on energy infrastructure since the destruction of the Nord Stream gas pipelines last month. NATO defense chiefs are gathering in Brussels today to discuss how to better protect critical infrastructure, ramp up weapons production, and maintain support for Ukraine. Meanwhile, the U.S. is speeding up shipment of 2 advanced air defense systems to Ukraine in response to pleas by President Volodymyr Zelensky for partners to supply more weaponry in the fight against Russia. The UK economy shrank unexpectedly in August for the second time in 3 months, raising the possibility that the country is now in a recession. The Office for National Statistics says the sharp 0.3% drop in industrial production was a main cause of the decline. Many analysts anticipate the drop means the economy will be lucky to avoid a downturn in the third quarter, marking the start of a cost of living recession. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change